Welcome members to the Borivali Central CPE Study Circle's virtual CPE meeting. This is the fifth CPE meeting for the year 2021 and one of the much awaited meeting on the budget, which all the members anxiously wait for to hear from the learned speakers. So today we have learned speaker C. Bhadresh Doshi with us, and we also have a presence of Honorable Vice President of ICI, Nihar Sir Jambusari. And before we start the proceeding, let us rise for the institute motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामंशो पुरुषो निर्मिमाणः तदेव शुभ्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः
Thank you, Dipen. Uh, uh, Members, though the budget speech of the finance minister, honorable finance minister, was comparatively shorter, but there are quite a few amendments are there in her baggage. So to discuss the same, we have today learned speaker Bhadresh Doshi. But before that, we also have a presence of Vice President Sir Nihar sir. And may I request Nihar sir to give his opening remarks on this for this session. Thank you.
Thank you. Thank you, Lalit. Good evening, everybody. CA Lalit Panchal, convener of the study circle. CA Deepan Sumaria, deputy convener. CA Vijay JM, past convener, and today's very learned speaker, CA Bhadresh Doshi. The other members of the core group and the members of the study circle. Again, it's an event for which we all eagerly await. And year after year, I was given the opportunity of speaking on budget. This year, for two reasons, we have Bhadresh Bhai to speak. Number one, he is a very good speaker. And number two, even I have difficulty. I have to take charge as the president on 12th February. So the preparations are going on. However, I thought I will come and this is the opportunity to meet members in whatever way COVID-19 permits us, because even now physical meetings in large number are not possible. So with the restriction of around 200 members, it would not be possible to conduct an event like budget meet. So I very well understand that again we are meeting like for the entire year on virtual mode, and we are waiting for the time when everything will open and we will be able to meet the way we used to meet in the past so many years. For the budget, the learned speaker is prepared with every clause of the finance bill. So I don't have to touch upon anything. I would only touch upon 4 points where there are apprehensions about what is going to happen to our audit practice. Particularly, you have seen that this year, if the cash transactions are confined to 5% of total transactions, then the turnover limit for tax audit has been raised to 10 crores. To my mind, probably, particularly in non-corporate entities, we may hardly find entities having 95% of transactions through banks, and the audits beyond 5 crore or 1 crore may continue. But in corporate entities, it is possible that many entities have adopted the banking system and they have avoided now the cash system of dealing in any transaction. So those audits may not come up if the turnover is within 10 crores. And as the time changes, the only fact remains that if the government finds that somehow the technology is able to deliver what chartered accountants in the form of audit reports were delivering, then why have tax audit or why have a particular audit? Again, I would personally feel that even in case of smaller taxpayers, where the turnover is below 10 crore and the transactions are by check or banking channel, still, in my opinion, the department would have value add if the tax audits are continued, because so many disallowances, chartered accountants compute and give them on platter. I don't think they have any software through which they can penetrate into taxpayers' accounts and find out the disallowances. And in that case, they may have to largely depend upon only the scrutiny assessments. Let us hope scrutiny assessments will not increase. Another aspect, today I understand you are dealing with direct tax provisions of the finance bill. However, one similar provision in GST audit where form number 9C is not required now. So there also, particularly the institute has compiled data and is submitting that it is not that for the benefit of our members we would like to continue GST audit, but if you look at what chartered accountants have changed in terms of GST liability from what the client had computed, they would be able to appreciate that 9C did make huge difference for the government. Let us see how the government is convinced or not convinced. But this is one area about which there is a concern in the profession. And time has come when we are not able to say that our profession requires it, but we have to demonstrate how country requires it and how the department requires it. The third is faceless income tax appellate tribunal appeals. There is a feeling post budget many members have represented to the institute that if they go little phase wise and after the faceless assessments and faceless appeals with commissioner appeals are settled, if they take up tribunal appeals, it would be better, because many members have apprehension that in faceless appeals, probably ITAT being the last fact finding authority, if the facts are not properly understood and decisions are given, those cases will not be maintainable in high court. And therefore at appellate tribunal level, probably for a year or two, the physical appeals should continue. That is the feel of the profession. But if they don't agree, then this is one area in which probably study circles, regional councils, everybody will have to take up projects to train members and see that even we take up income tax appellate tribunal appeals when they are made faceless, we take them very effectively and see that clients don't suffer. And lastly, Bhadresh bhai may have made detailed analysis. I have not done this year because I did not have time, but I would like to just put an apprehension. You may deal with it when you take up this provision. For reopening of assessments, they've curtailed the time limit to 3 years. This is certainly a welcome step. But on the other hand, what they provide is that if undisclosed, if there is an evidence of undisclosed income, then the case can be reopened up to 10 years. Although they make provisions where they have put checks and balances. The only doubt that I may have, because looking at past experience, that they should not mix up uh, income escaping assessment with evidence for undisclosed income. And if they mix up and continue to reopen assessments, even where there is only escapement of income under the existing section 147, then it will be a bad scenario and many cases may get opened. And for this purpose, whether the checks and balances that they have offered, like a panel will consider, whether they are enough or not, and whether in letter and spirit they will follow these provisions is one question in the minds of many. So except for this, I think there are many amendments proposed in the finance bill, and Bhadresh bhai will have tough time to finish in the limited time. So I will not take much of time, but thank you again for inviting me. Whenever I come to BCSC, it is like homecoming. And therefore, whenever there is an invitation, at least for 5 minutes, I would feel that although I am not able to see all members, at least members can have some communication from me. Thank you so much. Back to you, Lalit. Thank you.
Thank you so much, sir, for enlightening us on the your apprehensions you have on the budget, and thanks for sparing your valuable time with us. And now, may I request our past convener C. Vijay JM to formally introduce our learned speaker C. Bhadresh Doshi.
Good evening, members, and it's my pleasure pleasant task to introduce our speaker, CA Bhadresh Joshi.
I will
Yes.
take leave because there is another video conference, and
Okay.
I will miss opportunity to listen to Bhadresh bhai. But still, if you are recording, I will listen later. Thank you. Thank you so much.
Thank you, sir.
Thank
Thank
you.
you so
Thank you.
much.
Thank you.
Thank you, sir. See, Bhadresh Joshi has qualified in the year 2001. He has secured merit rank on all India basis throughout his CA examination, like achieving 23rd, 33rd, and 11th rank in CA Foundation, Inter, and Final, respectively. He has cleared his paper on principles of international taxation as part of ADIT courses conducted by the Chartered Institute of Taxation, UK. He is practicing in a firm called Bhadresh Joshi and Associates since last 18 years. As far as professional exposures are concerned, his practice are in the litigation matters up to ITAT levels and consultations on income tax matters, including international taxation. He is the member of the Managing Council of Bombay Chartered Accountants Society, also a member of General Committee of BCSC, sorry, not BCSC, BCAS. He is a General Committee of CTC. He has co-authored the controversy article, which is published every month in BCA Journal. He has also co-authored a book on Income Declaration Scheme 2016 for BCAS, which he has had an occasion to present it to the Honorable Finance Minister, Mr. Arun Jaitley. He also presented various papers on taxation at various forums. With this brief introduction, I introduce you to the BCSC family, sir. Now, it's a practice of a Borivali Central CP Study Circle to contribute rupees 500 as a speaker contribution to CABF. Thank you, sir. Now you can take charge of the session.
Yeah, so my screen is visible.
Yes, sir.
Okay, thank you. So, convener of Borivali CP Study Circle, Lalit ji, Dipen ji, Vijay ji, and all the participants, good evening and my virtual namaskar to all. I have been told that it's as a tradition for Borivali CP Study Circle every year, nearby is supposed to take this particular presentation on analysis of finance bill every year. But since now nearby is moving up on the ladder, is busy. But my worry is that whether I'll be able to meet the expectations of all the participants or not. Uh, as you people are all comfortable with nearby speaking on the finance bill. Uh, uh, Friends, there are about over 95 amendments which have been proposed to the Income Tax Act through this Finance Bill 2021, and I have a limited time of 2 hours. Uh, Even out of those 95 amendments, I picked up a few of those amendments which I felt that it will be relevant for the participants in general, and therefore I'm not going to take up those amendments which are basically dealing with typical provisions like international taxation on sovereign funds, etc. So I have compiled a presentation of around 145 slides. So I have limited time to deal with all these amendments. So uh, wherever I feel that the particular amendment is going to hit us at a mass level, I'm going to deal with those amendments in detail. The other amendments, I'll just make a reference and I'll just run through the slides. If you have any questions or queries related to those amendments, you can always put up your question in Q&A section. And if time permits, I'll try to deal with those questions coming to me. So before we begin the analysis of this Finance Bill 2021, just 1 minute, I see some issues with respect to my screen.
Sir, you can stop share and again try once.
Yeah, just give me a minute. Is this visible once again? Slideshow?
Yes, sir. Yes, sir.
Yeah. So nearby started with referring this particular amendment of tax audit. So even I thought that I should also start with this particular amendment on a tax audit. So the finance minister, the theme of this particular budget, as it has been mentioned in the budget speech of the finance minister, is Atmanirbhar Bharat. So in a sense, if you see indirectly, the income tax department wants to become Atmanirbhar to the extent this particular exclusion which has been granted as far as the tax audit is concerned for small and medium sized taxpayers. So let's see what the amendment is. As you must be knowing that the last year the Finance Act 2020 had introduced a proviso in section 44AB, increasing the threshold of rupees 1 crore to 5 crore, subject to the two conditions: that aggregate of the receipts in cash should not be more than 5% of total receipts, as well as the second condition which was required to be satisfied was aggregate of all payments in cash should also not be more than 5% of total payments. So if in a case where both of these conditions are satisfied, only then this increase in threshold to 5 crore was applicable since last year. Now there is a proposal in this Finance Bill 2021 whereby this threshold of 5 crore is now being increased to rupees 10 crore, which will apply from this current running financial year, and that means assessment year 21-22. So in a case where your turnover of a business is not more than 10 crores, and provided both of these conditions are satisfied, there is no requirement to get the books of accounts audited. You may please note that there is no change in a case as far as the professionals are concerned. The turnover, the limit of gross receipts of 50 lakhs continues as it is. There's no change as far as this case is concerned. You may please also note that there are no changes as far as the provisions of section 44 AD are concerned. So in a case where the turnover is not exceeding rupees 2 crores, and if some other conditions are satisfied, and because of which the subsection 4 and subsection 5 of section 44 AD are becoming applicable, in that case, the person carrying on that business is also required to get the books of accounts audited if the required percentage of profitability has not been offered. And therefore, friends, what is going to happen in practice is that those small size businesses where your turnover is not more than 2 crore, there is a condition that you need to offer the profits at a certain percentage of your turnover, which is at 6% or 8%, depending upon the mode in which you are receiving the sale consideration of your for your sale of goods. If you are not able to offer your profitability at that given percentage, and if some other conditions like total income exceeding the maximum amount which is not chargeable to tax, etc., in that case there is a mandatory requirement that your books of accounts should have been audited by a chartered accountant. So that is a requirement as far as the small businesses are concerned. But as compared to this, if you compare the class of SSEs where they are carrying on a business and the turnover of those businesses are more than 2 crores, but up to 10 crores and not more than 10 crores. In this particular class, there is no requirement of offering the profitability at a particular percentage, irrespective of what is the profitability you are offering, whether you are offering at 8% or 6%, or even in a case where you are incurring losses and therefore you are declaring losses in your return from your business. It is irrespective of this, the requirement of tax audit is not applicable to you, of course subject to satisfaction of those two conditions about cash receipts and cash payment. Each one of this is not exceeding 5% of your total receipts and total payments. So if you are able to satisfy both of those conditions, then the profitability is not the concern. It is irrespective of the profitability, you are exempted from getting your books of accounts audited and submit your tax audit report. So I am just trying to draw your attention to this particular discrimination which has been created under the law vis-a-vis small businesses, that they have been asked to declare the profitability at a certain percentage else to get the books of accounts audited, and as compared to this medium sized businesses of having turnover of 2 crore to 10 crores, irrespective of the profitability, you are not supposed to get your books of accounts audited. As I referred, friends, that there are about 95 amendments to the Income Tax Act through this Finance Bill 2021. And out of all of these 95 amendments, when I made an analysis, I realized and I came to know that there's no single amendment which is resulting into a direct gain to the taxpayers at large. Of course, there are some procedural amendments. I'm not on the procedural benefits in like a reduction in the time limit to reopen the assessment. I'm not on those procedural aspects. I'm on those aspects which should have resulted into some kind of direct gain in terms of computation of income or computation of tax liability. There are a couple of them. I know 43CA, the threshold has been increased, and LTC exemption, etc. But friend, those were the benefits which were already being announced through those press release forming part of Atmanirbhar Bharat package from time to time. And it is only now corresponding amendment have been incorporated in the act. So what I felt, friends, is that 44AD was a provision which needed the attention of the finance ministry, at least for this year of COVID-19, because all of us know that it was a very struggling period for every one of us. And therefore, small businesses typically for this particular year of COVID-19, asking them to declare profitability at a certain percentage. And if they are not able to declare that kind of a profitability, then putting more and more obligation on them. Perhaps there was a need to relax some of this requirement as far as this provisions of section 44AD is concerned, but nevertheless we don't see any corresponding amendment. So what were the statistics as far as this tax audits are concerned? And therefore I thought that I should share the statistics with you so that you can have a rough idea about how this amendment is going to impact. So friends, the tax audit reports which were filed for assessment year 2019-20, total number of tax audit reports which were filed were 28,25,680. So these are the numbers which have been picked up from that instruction denying the extension of the tax audit due date, ITR filing due date. Of course, these numbers includes even the tax audits cases where the person is carrying on a profession. It also includes the cases where the tax audit has triggered due to the operation of the provisions of section 44AD or ADA. Now, out of this, how many of them have declared turnover of rupees more than rupees 10 crore in the same year, that is financial year 18-19? The numbers are just around 3,50,000. And this number is coming from, once again, CBDT press release only with respect to those TCAs on sale of goods. So if you refer to that press release, this number will become clear. And therefore, out of 28 lakhs and odd figure, the number of cases where the businesses are declaring turnover of more than 10 crore is just coming to 3,50,000 or odd. And therefore you can realize as to how this amendment is going to impact all of us. So I'll just leave this particular thought here and I'll just move on to the next amendment relating to capital gains. So coming to capital gain, the amendment is trying to take care of some of the existing loopholes, or whether to call it as a loophole or to name this something else, I don't know. But as far as restructuring of partnership firm is concerned, we have existing provisions of section 45(4). And this existing provisions of section 45(4) was not able to take care of some of the transactions of restructuring in a partnership firm where partners were gaining a huge amount and they were going tax free. So in order to overcome this particular problem, some of the amendments have been proposed by the Finance Bill 2021. So let's try to understand this particular amendment. So before we go to the amendment, we need to have a recap of what the existing provision is. So in existing provision of subsection 4 of section 45, it talks about a case where the partnership firm is dissolved, or even otherwise, not by way of dissolution, but for some other reason, the capital asset of the partnership firm are getting distributed to the partners of the partnership firm. In this particular case, so if there is a transfer of a capital asset by a partnership firm to the partner because of dissolution or otherwise, in that case, the capital gain becomes chargeable to tax in the hands of the partnership firm in the year of that transfer, and fair market value of the asset on the date of that transfer becomes the full value of consideration. So this is an existing provision. And under this existing provision, what happened in the past? So these are some of the court cases which are interpreting this existing provision in a case where the retiring partner is receiving either monetary consideration or some capital assets in kind, the value of which exceeds the capital balance of the partner in the books of the partnership firm. So just to give you an example, if I am a partner in a partnership firm and I am retiring from that partnership firm today, and for example, my capital balance in that partnership firm in the on the date of retirement is, let's say for example, 10 lakhs. Now, as against this 10 lakhs of capital balance, the partnership firm is paying me a monetary consideration of rupees 50 lakhs. So there is a difference of 40 lakhs. I am being given the excess amount of 40 lakhs over and above my capital balance. So in many cases in the past, a dispute arose, the question arose that whether this 40 lakhs of excess amount which I have received as a retiring partner from my partnership firm, whether this excess amount of 40 lakh becomes taxable either in the hands of the partnership firm or in the hands of the partner. And with respect to this particular question, there are a lot many decisions which I have given in the slide, right from Supreme Court to High Court, and all of those courts have said that sorry, the partner, retiring partner cannot be taxed with respect to this excess amount received, irrespective of whether it is a monetary settlement or whether it is a settlement of asset in kind. Is because section 45 subsection 4 triggers only in the hands of the partnership firm and not in the hands of the partner. And therefore, if at all, if you want to tax such a retirement transaction, you have to tax the partnership firm, and that too only in a case where a capital asset is moving from the partnership firm to the partner with respect to the gain which is arising in the hands of the partnership firm. So we had Mohan by Pamabai decisions of Supreme Court, and then Bombay High Court decision, the latest one in the case of Hemlata Sethi. And therefore, this 40 lakhs of difference in my example, which I shared with you, was going totally tax-free. The department could not tax the difference of 40 lakhs of rupees. However, when I am referring to all of those decisions, I'll be failing in my duty if I don't point out that there were contrary decisions of some of the tribunal. In one of the case of Sudhakar Sethi of Mumbai Tribunal, and in one of the other case of Bangalore Tribunal, in the case of Savitri Kadur, where a view was taken by tribunal that it will depend upon the mode of settlement. I'll not go into the details of this. I'll just leave this point here because now we are concerned with the amendments and not we are not concerned with what were the decisions earlier. So now the amendment is trying to hit this particular case where the retiring partner, or irrespective of whether it is on retirement or on any event, basically the amendment is trying to take care of a situation where a partner is gaining something from a partnership firm. The partner is receiving something which is in excess of his capital balance in the partnership firm. So the memorandum very categorically is referring to this particular statement. So I'm just capturing this memorandum in the slide because this needs to be taken into consideration when we are going to deal with some of the issues which are going to arise, because this manner in which these amendments have been proposed, it is becoming really a complex scenario for us to understand and interpret this particular provision. So now what the amendment is that the existing provisions of subsection 4 has been done away with, and new subsection 4 has been introduced, replacing the whole of the existing subsection 4. In addition to new subsection 4, we have one more provision, which is subsection 4A. And both of this have been inserted with effect from assessment year 21-22. And therefore, both of these provisions are going to become applicable even with respect to any transaction if it has already been executed with effect from 1st of April 2020. So for the purpose of understanding these two provisions, we need to understand some of the definitions. So there are two persons which are basically involved. And of course, those persons are partnership firm and the partner. But in this provisions, they have been referred as specified person and specified entity. So who is that specified person? The specified person is the person who is a partner in a partnership firm, or alternatively is a member of AOP or BOI, because this provisions, even the existing provision of subsection 4, was also applicable not only to the partnership firm, but was also applicable to AOP as well as BOI. So specified person is a person who is a partner of a firm or member of AOP or BOI, and specified entity is that partnership firm or alternatively AOP or BOI. So in my subsequent slide, you will see a reference to SP and SE. So SP, whenever I'm referring, it is a partner, and SE, whenever I'm referring, is a partnership firm for the purpose of our understanding. So now let's try to understand what subsection 4 is first. So subsection 4 trigger point, when this particular subsection 4 is going to come into picture. So it says that the applicability of subsection 4 is subject to all of these conditions. And what are these conditions? It says that when a specified person, that means a partner, is receiving any capital asset. So here itself, it is making a difference. The existing subsection 4 was becoming applicable in a case where there was a transfer of a capital asset by a partnership firm to a partner upon dissolution or otherwise. So the reference was to the transfer of the capital asset by the partnership firm to a partner. But under the new amended provision, the reference is not to a transfer, but the reference is to a receipt of a capital asset by the partner. I understand that whether you refer this transaction from one side or you refer the transaction from the other side, it doesn't make really a big difference, but that is how the provision is worded, and it is going to result into some of the issues which I'm going to discuss in a later course of the presentation. So subsection 4 says that when a partner is receiving any capital asset at the time of dissolution or reconstitution of the partnership firm. So existing provision of subsection 4 was referring to the words dissolution or otherwise. And we know that this word otherwise was becoming a subject matter of dispute. And in past, a dispute arose that whether the retirement of a partnership firm will fall into this word otherwise. And the taxpayers were arguing that otherwise, the word otherwise should be given a meaning something which is similar to a dissolution. And in case of retirement, this firm is not getting dissolved. But nevertheless, in the Bombay High Court, in Anil Naik case, it took a view that the word otherwise will also include the retirement type of cases. And therefore, perhaps in order to avoid all of those disputes which might arise in future also, instead of using dissolution or otherwise, now the amended words are dissolution or reconstitution. And therefore, any type of reconstitution of a partnership firm will get covered into this. Now, what is dissolution? We know, but what is reconstitution? This term reconstitution is something which is not being defined under this new provisions of subsection 4 or 4A. So perhaps reconstitution is, once again, might be an issue which might arise, that whether reconstitution will be taking care of every type of reconstitution. So for example, we can think of a case where a partner is not retiring at all, partner is continuing, but there is a change in the profit sharing ratio. So till today, I was entitled for 50 percentage of profits, but now because of the reconstitution, my profit sharing has been reduced from 50 percentage to 5 percentage. So whether this change in the profit sharing ratio will also be included in this term reconstitution or not, once again, might be possible that this issue will arise. But in the context of section 186 and 187, the reconstitution includes such type of change, even the mere change in the profit sharing ratio. So going further, subsection 4 is referring to a case where a partner is receiving any capital asset at the time of dissolution or reconstitution of the partnership firm, which represents the balance in his capital account in the books of the partnership firm at that point in time. So we need to correlate the capital asset which is received should be the one which is representing the balance in the capital account of that particular partner. So this correlation, which was not there in subsection 4, existing provisions of subsection 4, has been now inserted in new provisions of subsection 4. So keep this particular point in mind. We'll be discussing more in the subsequent slide. Before I proceed, I must point out that when you are correlating the capital asset which is received with balance in the capital account, this balance in the capital account should be considered without taking into consideration any effect of revaluation or effect of raising self-generated assets like goodwill, etc. So it should be the real capital balance of the partner which is standing in his capital account, and only that particular amount is required to be considered. So if my capital balance was 25 yesterday and now revaluation entries have been passed and my capital balance is increased from 25 to 100, for the purpose of applying subsection 4, I cannot say that my capital balance is 100. I will have to exclude the effect of revaluation from my revised capital balance, and only the 25 of my capital balance prior to revaluation is required to be taken into consideration. Now, if this subsection 4 is becoming applicable, what will be the outcome of this? The outcome of this, it says that any profits or gain arising from receipt of that asset by the partner, it will be chargeable to tax as capital gain of the partnership firm. So see the kind of deviation which it is making from the existing provisions of subsection 4. Under the existing provision, the profits or gain which was arising from the transfer was taxable, and now it is referring to the profits or gains arising from the receipt of the capital asset by the partner. So it is the profits or gain of the partner who is receiving this particular capital asset is deemed to be the capital gain of the partnership firm, which is taxable under the year capital gain and which will be taxable in the year in which this particular asset was received by the partner. Now, if this is becoming taxable, the computation mechanism has been altered slightly, and subsection 4 itself is providing that for the purpose of section 45, the capital gain of the partnership firm will be computed in the following manner. And two things have been clarified. That the first one is that FMV of that capital asset on the date on which that was received by a partner, it will be deemed to be the full value of consideration, and the original cost of that capital asset is required to be reduced from the capital gain to be computed, and this cost of acquisition of the capital asset will be computed as per the general provisions which are applicable for any other asset. And therefore, if you can realize, the computation of capital gain is with respect to the from the point of view of the partnership firm, it is taxable in the hands of the partnership firm, but the subsection 4 is merely making a reference for the purpose of taxability to profits or gain which is arising to the recipient and which is deemed to be the capital gain of the partnership firm. Now with this, let me proceed further and let me deal with subsection 4a, which is a new provision which has been introduced now. And here also, now let's first try to understand what is the trigger point of 4a. The trigger point of 4a is the similar one, but slight difference which has been created. So 4a provides that this provision will become applicable in a case where once again a partner is receiving any money or other assets. So point to be noted here is that the 4 was referring to receipt of a capital asset, but 4a is now not referring to a capital asset only, it is referring to receipt of any money or other asset. So if money is being received by the partner, subsection 4 cannot be made applicable. If money is received, subsection 4a can be made applicable. So that's where the difference is. And in addition to money, it is making reference to other asset. It is not making a reference to a capital asset, and therefore perhaps there is no need to apply the definition of a capital asset for the purpose of subsection 4a. So for example, if there is an assignment of receivable by a partnership firm to the partner, perhaps even subsection 4a would be becoming applicable even with respect to this assignment of receivable to some extent. So that is where a point to be noted. Now, if a partner is receiving any money or other asset, once again at the time of dissolution or reconstitution of that partnership form, so that there is no change as far as the occasion of receipt or the event with respect to which this particular money or other asset is being received. Now, as far as this correlation is concerned, as we noted that in subsection 4, the correlation of the asset received was with respect to my balance in capital account. The words were it should represent my balance in the capital account. So that's where the difference is, which is now being created in subsection 4a. So once we come to 4a, the correlation between the asset and the capital balance is like this. It says that the money or other asset which you have received, it should be something which is in excess of the balance in the capital account. So the trigger point of 4a is the monetary settlement or any other assets in kind, if at all it has been given to the partner, the sum total of this should be something which should be in excess of the capital balance of that partner who is receiving this. And once again, for the purpose of this capital balance, you need to ignore the revaluation difference or any self-generated goodwill or other asset which has been created and credited to the capital balance of the partner. So if 4a is becoming applicable, what's the outcome? The outcome is that once again, there is a reference to the profits or gain which is arising from the receipt of this money or other asset by the partner, but it creates a deeming fiction whereby this profits or gain which is arising to the partner, because he is receiving something in excess of his capital balance, by deeming fiction, it becomes a capital gain of the partnership firm. Please note that even in a case, to carry forward the same example, my capital balance was 10 and now I have been given 50. The difference of 40, which is a profit or gain which is arising to me as a partner, it doesn't become my taxable income by virtue of even the amended provision. In the amended provision, this difference of 40 is deemed to be the capital gain of the partnership firm once again, which is deemed to be a capital gain chargeable to tax in the previous year in which I have received this as a partner. Now, what are the alterations which are required to be made to the computation is because now the taxability, the profit or gain which was arising to the partner because he was receiving something in excess of his capital balance is now becoming deemed capital gain of the partnership firm, and therefore we need to alter the computation mechanism. And here the alteration has been provided in subsection 4a. It says that for the purpose of computing this capital gain under 48 in the hands of the partnership firm, what you do is that you take a sum total of money which was paid to the partner, or if the assets have been handed over to the partner, take fair market value of those assets on the date of receipt by the partner. Sum total of these two will be considered. It will be deemed to be the full value of consideration, and the balance in the capital account of the partner without taking into consideration this effect of revaluation or raising of goodwill, etc., that balance in the capital account shall be deemed to be the cost of acquisition. And therefore, to make it very simple, carrying forward the same example, if my capital balance is 10, I have been given monetary amount of 50, it simply says that 50 becomes your full value of consideration in the hands of the firm, and capital balance of 10 becomes the cost of acquisition, and therefore the difference of 40 becomes deemed capital gain, which is taxable in the hands of this partnership firm by virtue of this provisions of section 4a. So just to summarize both of this provision, because I'm sure that a lot of questions must be coming in your minds, and therefore before we proceed to deal with the issue, let's summarize and just have a quick recap of what subsection 4 is and what subsection 4a is, and what are the important differences between two of this. So I have just presented a summary of both of this provision in a particular slide. So when these provisions are applicable, both of these provisions are applicable when something is received by a partner from a firm. So make a point of this. Both of these provisions are applicable only in a case where a partner is receiving something from a partnership firm. What is the occasion of the receipt for both of this provision? The occasion for which something is received should be dissolution or reconstitution of that partnership firm. Now, what should have been received by the partner in order to apply any of these two provisions? So here there is a difference. Subsection 4 is referring to capital asset and subsection 4a is referring to money or other assets. So please keep this particular point in mind. How do you correlate the receipt vis-a-vis your capital balance? For the purpose of subsection 4, we need to see whether the capital asset which you have received as a partner, whether it is representing your balance in your capital account in the partnership firm. And for the purpose of 4a, the condition is that the money or other asset which you have received, the sum total of this should be in excess of your balance in the capital account. So that's where once again the difference is. In both of this provision, who is taxable? It is the partnership firm who is taxable. The recipient, that is a partner, is not taxable at all under either of these two provisions. If at all any of these two provisions are becoming applicable and therefore it is deemed to be the capital gain of the partnership firm, how do you compute the capital gain, which I've already dealt with in detail with the help of example, and therefore I'm not repeating it once again. But just to make a point, subsection 4's computation is something which is similar to the existing provisions of subsection 4, which is FMV of capital asset minus cost of that asset, and 4a is sum total of this money or other asset and capital balance to be reduced from this, and that is how you arrive at the capital gain for the purpose of a partnership firm. Now that's how the provision is. So now let's try to understand some of the issues which are going to arise. The first issue which I want to raise over here is that, agreed that this is becoming capital gain of the partnership firm under both of this provision, the question is that how do you determine this capital gain, whether it's a short-term capital gain or a long-term capital gain? So if you are dealing with subsection 4, perhaps in that case this issue might not arise, and you may argue that the capital asset which has been received by the partnership firm, retiring partner, you see what is the period of holding of that particular capital asset. Accordingly, you decide whether it is a short-term capital gain or a long-term capital gain. Agreed. Leave aside subsection 4 for a moment. Even in subsection 4, that issue might arise, but leave aside subsection 4 for a moment. Go to subsection 4a and tell me in subsection 4a, how are you going to decide whether this capital gain is a short-term capital gain or a long-term capital gain in the ends of the partnership firm? There is no clarity absolutely in the provision which have been proposed. Here, if you see, the reference is to money or other asset. And therefore, take a very simple vanilla case, the same example, my capital balance was 10 and I have been paid 50 rupees against this. And therefore, here only money is moving. There is no movement of any other asset. And therefore 40 rupees which I am receiving in excess, which is becoming deemed capital gain of the partnership firm. How are you going to decide whether this 40 rupees of capital gain, whether it is a short-term capital gain or a long-term capital gain? Is because there is no movement of the capital asset. There is no period of holding of the capital asset. Are you going to determine the nature of capital gain on the basis of the period for which I was a partner in a partnership firm? If I was a partner for more than 36 months, you're going to say that this 40 rupees is becoming long-term capital gain of the partnership firm. And if my period was lesser than 36 months, it is becoming short-term capital gain of the partnership firm. Yeah, perhaps there is a logic, that is a logical conclusion which one is trying to draw, but there is nothing in the law which is providing any clarity for the purpose of determining this nature of capital gain, whether it is a short-term capital gain or a long-term capital gain. The next issue which is arising here is that whether both of these provisions 4 and 4a, whether these provisions are mutually exclusive to each other, and therefore in any given case either you will apply 4 or you will apply 4a and not both of this at a same point in time, or whether both of this provision can be made applicable simultaneously in any given case. So this particular issue is the complex one, and therefore I'll just try to deal with this issue by giving some simple examples so that it becomes very clear to all of us. So in this example, to begin with, the capital balance of the retiring partner was, let's say, 25 lakhs. And this particular partner has been given an asset which was otherwise belonging to the partnership firm upon retirement. And what were the figures of that particular asset? The asset which has been given to the retiring partner, the cost of that asset was 10, and the fair market value of that asset on the date on which it has been given to the partner was, let's assume, is 25. And therefore, if you see, the retiring partner is receiving an asset, the FMV of which is 25, as against that the capital balance of retiring partner was 25, and there was no revaluation, no credit of goodwill, nothing in this particular capital balance of 25. And therefore, you can conclude that this asset of worth rupees 25, which the retiring partner is receiving, is in fact nothing but it is something which is representing his balance in the capital account itself. And therefore, if the asset received is representing the balance in the capital account, we need to apply the subsection 4 of the amended subsection 4 of section 45. And therefore, if you apply subsection 4 of 45, in this case, the taxable capital gain would be FMV of that asset, which will be becoming full value of consideration, which is 25, and the cost of asset of that asset in the hands of the partnership firm, which is 10. And therefore, the difference of 15 rupees will be becoming deemed capital gain of the partnership firm. As a simple example, this has nothing to do with the issue which I'm raising, whether these are mutually exclusive or not. In the next illustration, so to proceed with, I'm taking very simple example so that we can understand this first. And the next example, I'm going to add more and more complication. But before I proceed to the next example, the one point which I thought that I should just raise over here is, if you refer to subsection 4, we are concluding in that example that this is subsection 4 which is going to apply. But if you refer to subsection 4, it is referring that there should be some profits or gain arising from receipt of that capital asset by the partner. If there is any profits or gain which is arising from receipt of the capital asset by the partner, then it will be deemed to be the capital gain of the partnership firm. So very hyper technical issue which might arise over here in this example is that, can you say that this 15 rupees of capital gain, deemed capital gain, which we are concluding that it will be taxable in the ends of the partnership firm, is in the nature of some profits or gain which is arising to the partner? The answer to this is, technically speaking, no, because as a partner, my capital balance was 25. I have received an asset worth rupees 25 upon my retirement, and therefore I am not gaining anything out of this particular transaction. But it will be very hyper technical. But since there is a deeming fiction which has been raised, which has been created in subsection 4, perhaps in this example, subsection 4 will become applicable, and 15 rupees of capital gain will be deemed capital gain of the partnership firm. Now let's consider the same example by adding some more facts. So my capital balance continues to be 25. I am retiring from the partnership firm, and upon my retirement, I have been given an asset. The cost of the asset in the hands of the partnership firm is I'm putting the same figure of 10, but the FMV of that asset was worth 100. And therefore, what has been done is that prior to my retirement, the partnership firm is revaluing that asset. So the asset has been revalued to 100 in the books of the partnership firm. And because of that revaluation, even my capital balance, which was 25 prior to revaluation, has now been increased to 60. So there is a revaluation gain of 35, which is getting credited to my capital balance because of that revaluation prior to this restructuring of the partnership firm. Now, I am retiring after this particular revaluation has taken place in the books of the partnership firm. And upon my retirement, I have been given this particular asset, the cost of which was 10, fair market value of which was 100, and it was revalued at 100 in the books of the partnership firm. Now here complexities are arising. How do you apply this provisions of section 45.4 and 45.4a? So going back to that slide where I'm raising the issue which is going to arise in this example is that whether both of this provision 4 and 4a are mutually exclusive to each other. And how do you decide if you conclude that they are mutually exclusive? How do you decide whether 4 is applicable or whether 4a is applicable? Do you decide on the basis that if the asset is received which is representing the capital balance, that means it is not more than capital balance, then you apply only 4. And if it is the value of this particular asset, if it is more than the capital balance, then you apply 4a. So that is how you resolve this particular dispute, and that is how you decide that both of these are mutually exclusive to each other, and therefore either you will apply 4 or you will apply 4a, but you won't apply both of those 4 and 4a simultaneously in this particular example. Is that a case? So let's see what is going to, eh, what will be the outcome of this if you take a view that they are mutually exclusive. So if we take a view that they are mutually exclusive, in this example, the figure suggests that I received the asset worth rupees 100, the FMU of that asset was 100, my capital balance, excluding the revaluation effect, was 25, and therefore what I'm receiving is something which is more than my capital balance upon my retirement, and therefore 4A should be made applicable. If you apply subsection 4A, in that case, once again, capital gain becomes chargeable to tax in the ends of the partnership firm. And how do you compute the capital gain for this purpose of 4A? The provisions, amended provision says that you take money which has been given to the partner and FMV of the asset which has been given to the partner. So in my example, it is only asset. So let's take the FMV of that asset, which is 100. And 4A further provides that the capital balance, excluding the effect of revaluation, goodwill, etc., will be deemed to be the cost. And therefore, my capital balance, if you see, it was 25. And therefore, the capital gain, the resultant capital gain will be 100 minus 25, 75 rupees of capital gain, which is becoming chargeable to tax in the hands of the partnership firm. So this is how you arrive at the taxable capital gain. I don't know how are you going to arrive at whether this 75 rupees of capital gain is a short-term capital gain or a long-term capital gain. Are you supposed to see the period of holding of that asset which has been given to the partner, or you are supposed to see the period for which I was a partner in a partnership firm? There is absolutely no clarity anywhere in the amended provision. So leave aside that issue. We have already discussed that issue. I am on an issue whether these are mutually exclusive or both of these provisions should be made applicable simultaneously. Now, if you take a view that these are mutually exclusive, what is happening over here is, friends, if you have seen that earlier, if I go back to the earlier example, my capital balance was 25, there was no revaluation, asset which was given worth rupees 25, and here you had concluded that 15 rupees of capital gain should be made taxable capital gain in the hands of the partnership firm. Now, if you take a view that 4 and 4A are mutually exclusive, let me just change this example slightly. If I add 1 rupee to this, if I hand over the asset worth rupees 25 and I pay 1 rupee to the partner, in that case, what is going to happen? Go back to that slide which is giving that comparison. So here in 4A, it talks about money or other asset. And therefore, 25 plus 1, if I am handing over this to the partner, so I'm making it 26, and my capital balance was 25, and therefore this amount of 26, the settlement amount of 26 is more than the capital balance of 25. And therefore, if you take a view that both of these are mutually exclusive, I am falling under 4A because the settlement amount, money or other asset, is more than the capital balance. And therefore, if you come to 4A, you will realize that the taxable capital gain is the settlement amount, money or FMV or the other asset minus capital balance. And therefore, if you are changing this example even slightly, even if you add 1 rupee here in this example, what is going to happen? That it is only that 1 rupee which will be becoming taxable capital gain on a deemed basis in the hands of the partnership firm, and this 15 of capital gain which we determined earlier, 25 minus 10, will not be taxable, will not be becoming taxable capital gain in the hands of the partnership firm, because we are taking a view that both of these are mutually exclusive. So what is happening if we take a view that these are mutually exclusive is very simple. What was taxable even under the existing provision of subsection 4, that itself is becoming tax free. And that's not the intention of this amendment. The intention of the amendment was that when a partner is getting benefits because he is receiving something in excess of his capital balance, there should be some kind of taxability on this. The intention was not to disturb what was being taxed even under the existing provision, and therefore by taking this view that both of these are mutually exclusive, it is creating this particular difficulty. Let's understand the same example, same figure, but by changing the view. And if you take a view that both of these are not mutually exclusive, but both of these provisions are can be made applicable simultaneously in any given situation. So here the example remains the same, the figure remains the same. Now, what will be the outcome of taking this view that both of this are becoming applicable simultaneously is that once you apply 45.4, you have to see the FMV of the asset and you have to reduce the cost of asset. And what is that FMV of that asset? The FMV of that asset is 100, and the cost of that asset in the hands of the partnership firm was 10. And therefore, by technically applying that particular provision of 4A, you will be coming to a conclusion 90 rupees of capital gain becomes taxable in the hands of the partnership firm under 45.4. I know that in my presentation, in my slide, I have not taken 100 minus 10 is equal to 90. I have taken 25. This is also for some reason. That is because if you take 100 over here, in that case, you are not giving any meaning to this particular words which are used in section 45.4. And the words which are used in section 45.4 is that the capital asset which is received by the partner is should be that capital asset which should represent the balance in his capital account. So if you take whole of the FMV of 100 for the purpose of computation, then in fact you are not giving any meaning to this particular words which have been used in subsection 4, that the capital asset received should be something which should be representing the capital balance of that retiring partner. And therefore one can apply a logical view that though entire FMV is required to be taken into consideration, but for the purpose of reconciliation of the charging provision with the computation provision, this computation is being altered by taking only 25, is because the asset worth rupees 100 which I have received, out of this only component of 25 is something which is representing my balance in the capital account in the books of the partnership firm. And therefore 25 minus the original cost of that asset 10, and that 15 becomes taxable capital gain under the provisions of 45.4. And once you come to 45.4a, the FMV of whole FMV of that asset 100 minus capital balance of 25, and the difference of 75 is becoming taxable capital gain in the hands of the partnership firm under the provisions of subsection 4A. And now if you see the sum total of 15 and 75, so that is total amount of 90. And how do you reconcile this? 90 is 100 rupees of FMV of that asset, and original cost of that asset was 10. And that is how the whole difference of 90 we are breaking into two parts. 15 we are bringing under 45.4, and 75 we are bringing under 45.4a. I know that this view is also having some problems. And what are those problems? The problem is with respect to the 25 which I have put in the red color. The problem is arising is because in 45.4, the computation provision says that FMV of that asset is required to be, or rather is deemed to be, the full value of consideration. And here FMV is 100, and we are altering that figure from 100 to 25. So whether that alteration in 45.4, whether that is something which is possible. If you take a view that that is something which is not possible, then we are coming to a conclusion that in 45.4, whole of 90 is taxable, and 45.4a, 75 is also taxable. And therefore in a way you are bringing a sum of 165 as deemed capital gain in the hands of the partnership firm. And therefore, this provisions 4 and 4A are made or rather worded in such a complex manner that three views which are coming from this, that whether you need to apply both of this by considering them as mutually exclusive. If you apply that view, you are coming across a situation where something which was taxable in under the present provision is becoming tax free. You apply in this logical manner which I have presented in this particular slide. In that case, the wording of 45.4 is not supporting me. If you apply literal wording of 45.4 and you are trying to apply both of this provision, we are resulting in a situation whereby the higher amount of, that is 165, is becoming taxable in the hands of the partnership firm. And therefore, I'm very sure that before this finance bill is becoming finance act, a lot of representation is required to be made with respect to this point, and a clarity is required to be brought as far as this particular issue which is arising. Few of the other points before I proceed to the other part of the amendment is that, as I mentioned to you, there is no definition of reconstitution, and therefore just change in the profit sharing ratio, will it make a case of a reconstitution or not? By bringing this taxability in the hands of the partnership firm and not in the hands of the partner, we are refusing that probability of claiming exemption under sections like 44, 54F, etc. Uh, in a case, we had a very recent decision of Mumbai Tribunal in the case of Anik Industries Limited, where partner was not retiring. There was just change in the profit sharing ratio. But what happened in this particular case was continuing partner paid some settlement consideration to the partner whose profit sharing ratio was reduced. So the issue arose that the transaction in a case where partnership firm is not paying anything, it's just continuing partners is paying some consideration to the retiring partner, whether this can be brought to tax. And here also, once again, Mumbai Tribunal took a view that no, this cannot be brought to tax. Now, even under the amended provision, because the amended provisions are applicable only in a case where the partnership firm is giving something to the partner, and therefore, in a case where there is no movement of funds or asset from a partnership firm to a partner, but just continuing partner is paying something or giving some asset to the retiring partner, 45.4 or 4A will not be becoming applicable even in that particular case. What will be the impact of 50C for the purpose of determination of fair market value? Can you just apply a stamp duty valuation over this? There are cash flow issues. This is something which is very important, friends, for the purpose of our understanding practically, is because the firm is paying something to the partner, so that to that extent fund is moving from the partnership firm to the partner, but the taxability is on the head of the partnership firm. And therefore, if partnership firm has paid whole of that consideration to the partner, from where the partnership firm is going to discharge this tax liability. So in any case of settlement now, with this particular point is required to be taken into consideration, that there has to be enough liquidity in the hands of the partnership firm for the purpose of discharging this particular taxability which is arising under the amended provisions of 45.4 and 45.4A. There are consequential amendments to section 48. So this consequential amendment is trying to take care of a situation where an asset belonging to a partnership firm was being revalued. After revaluation, that asset has not been given to the partners. That firm continues to be the owner of that asset, but that revaluation was being made only in order to arrive at the settlement amount to be paid in monetary form to the partner. So let me go back to that example. So in this particular example, in my original example, we had assumed that the asset was being given by a partnership firm to the partner. Now let's alter that example. In this particular example, the revaluation is done, asset has not been given, but the corresponding amount has been given to the partner in a monetary form. So now the consequential amendment has been made to section 48, that in this particular case, when the same asset which was being revalued, if the firm is now selling, transferring that asset subsequently in future, in that case, for the purpose of computing the capital gain in the hands of the partnership firm, upon transfer of that asset in future, the amount which is required to be computed in a prescribed manner, so we'll be given some rule, the amount which was already being considered for the purpose of taxability under 4A will be reduced from the capital gain which will be arising upon subsequent transfer of the same asset. And that's quite logical, because I had revalued asset which was costing 10 to 100, and out of 100 some component of income I have already taken into consideration for the purpose of computing my capital gain under new provisions of 4A. And therefore, continuing this, if the same asset is being sold in future at 200, and if you charge me on capital gain of 200 minus original cost of 10, then 190 is consisting of some component which has already been taxed in my hands earlier upon retirement of that partner under provisions of 4A. And therefore, perhaps in order to avoid the double taxation, a corresponding amendment has also been made under the provisions of section 48. All of these amendments are effective with effect from assessment year 2021-22. So with this, I'll proceed further to deal with some of the amendments with respect to TDS. Uh, Conveners, please stop me if something is not clear, so that I'll come to know. Otherwise, I'll proceed in my way.
Sure, sir.
Yeah. So last year, friends, we saw an amendment to the Income Tax Act as far as TCS provisions were concerned. 206C, a new subsection 1H was inserted, which provided that if some of the conditions are satisfied, upon receipt of the consideration for sale of goods, you have to collect tax at source at 0.1 percentage. And now we see the further amendment in this finance bill with effect from 1st of July 2021, which talks about a similar case. And it provides that now you are not only supposed to collect tax at source upon receipt of the consideration for sale of goods, but now further you are also supposed to deduct tax at source when you are purchasing goods from someone else. So that particular person is now having two obligations: one, collecting tax at source upon sale of goods, and other, now deducting tax at source on purchase of goods. The rate of TDS is also 0.1 percentage, which I'm going to tell you in the subsequent slide. But before I proceed, the real question which is arising, friends, over here is that, are we moving in a direction of ease of doing business? Where is this ease of doing business if we have this kind of provisions in the act? Just asking that person to collect tax at source at 0.1 percentage, or asking him to deduct tax at source at 0.1 percentage, I don't think that it is making any sense. The objective, it appears that objective is to collect the data, but we, all of us, we are knowing that the data is there available in GSTN at transaction level for each purchase and sale of goods. Everything, all kinds of data is available with the same government. If this have been made applicable only to sale and purchase of goods, the transactions of which have not been reported on GST portal for some or the other reason, either because they are tax free, etc., and you are applying only in those restricted cases, then it can be still understood. But applying it all across to all transactions is something which is not fair, and this needs to be reconsidered. But nevertheless, we have a provision, therefore we will have to understand how this provision is going to apply. So for this purpose, payer has been defined as a buyer. And who can be a buyer for this purpose? It says that any person. Now there is no restriction that individual or HUF are not subject to this provision. They are also subject to this provision, provided your turnover, total sales, gross receipts, or turnover of a preceding financial year was exceeding rupees 10 crores. So if you come across any case where your turnover of a business was exceeding rupees 10 crore in a preceding financial year, we need to forget about ease of doing business. This phrase ease of doing business, friends, is not for you at all. Okay. So if this condition is satisfied, you will have to apply this new provision of TDS also with effect from 1st of July 2021. It has been provided that notification can be issued if found necessary for the purpose of exempting certain persons from this requirement of TDS under 194Q. I'll be referring to this particular possibility of issuing a notification in some cases. Who should be a payee for this purpose? Payee can be any person who is resident in India. What is the turnover of that payee, etc., is something which is not relevant. You are not supposed to see. You are supposed to see just your turnover. Moment your turnover of preceding year has exceeded 10 crore, you need to start applying this particular TDS provision. But it is not that each and every purchase of goods is liable to TDS. So which are those transactions which are liable to TDS under this provision? It refers to payment of any sum. I've highlighted certain words in red color because it carries some special meaning, which I'm going to point out in the subsequent slide. So payment of any sum if that payment is made for purchase of any goods, you are liable to TDS provided a threshold of 50 lakhs is crossed. So payment of any sum for purchase of any goods of the value or aggregate of such value exceeding rupees 50 lakhs in any previous year, once you are entering into this particular transaction, you are supposed to deduct tax at source. So there are two thresholds, and both of these are exactly identical to what we have today in 1H of 206C for the purpose of applying TCA. So first threshold is my turnover of the preceding financial year, and the other threshold is total purchase of goods from one particular supplier should be exceeding 50 lakhs. Till the time it is not exceeding 50 lakhs, I am not supposed to apply this new provisions of 194Q. And this threshold, friends, please note that we need to apply this threshold at pen level. So our system should be designed in such a manner, because you can't apply the threshold only at GSTN level. Is because if the person having different locations spread over different states, we need to apply this threshold of 50 lakhs at pen level, because this threshold is for a pay and not for a particular GSTIN. When are you supposed to deduct tax at source? Same provision as we have in other provisions of TDS, payment or credit, whichever is earlier. So for the purpose of TCS on sale of goods, we have to collect tax at source only upon receipt of consideration, but that is not the case here. Here for TDS on purchase of goods, we have to deduct tax at source on payment or credit, whichever is earlier. What will be the rate at which you are going to deduct tax at source is 0.1%, provided the payee has furnished a PAN number to you, because otherwise in the absence of PAN number, we have 206AA, and the current provision of 206AA is referring to higher rate, twice the rate or 10%, whichever is higher. But fortunately for this purpose, that higher rate is reduced to 5%. There is a consequential amendment to 206AA. And please note that now PAN or either of this is required to be obtained, because both have been made interchangeable. What is an amount which will be subject to TDS? So we have a threshold of 50 lakhs, and here it is not something similar to other threshold that once you cross, you have to apply TDS on the past amounts. That is not the case. So it is only in a case where it has exceeded 50 lakhs, you have to deduct tax at source only on an amount of purchase for more than 50 lakhs. So first 50 lakhs, no TDS, and moment you cross 50 lakhs of purchases from one particular pay in a particular year, you have to start deducting TDS, tax at source on that amount which is exceeding 50 lakhs. There are some exemptions from TDS. So what are those exemptions? One is that if you are supposed to deduct tax at source under some other provisions of TDS, then this provision will not apply. So this is perhaps a residual provision of TDS. No other TDS provisions are applicable. Then in that case, you come under this provision and start deducting tax at source. So other provisions of TDS are required to be given first preference over this new amended provisions of 194Q. And there is a second exemption, and the second one is something which is more interesting. It says that if on the same transaction TCS is applicable, what do? So if you come across a case where I am purchasing goods from Lalit Bhai, and I'm supposed to apply TDS provision, Lalit Bhai is also supposed to apply TCS provision, because my turnover has exceeded 10 crore, his turnover has also exceeded 10 crores. So on that same transaction, whether one party will deduct tax at source of other party and other party will will collect tax TCS from the first party, is that a case? The answer is no. This specifically taken care in this particular provision, because otherwise it is going to result into a funny situation. Both the parties to the transaction will start deducting and collecting tax at source or TDS respectively, depending upon the provisions which are applicable. So in order to avoid this, to make it more logical, there is a specific clarity in this provision which says that if any provisions of TCS are applicable on that transaction, then you are not supposed to deduct tax at source. Let that other person collect your TCS from you. You don't deduct tax at source. But if 1H of 206C is applicable, then you deduct tax at source. That other party will not collect tax TCS from you. I know that it is becoming too complex for us to understand, and therefore let me give more clarity with respect to this issue, that on same transaction, if TDS is applicable from my end and TCS is applicable from other end, who is supposed to do what? Okay, so this is a slide which is meant for general goods 206C1H, which was inserted by the last Finance Act 2020. And in last Finance Act 2020, the seller is supposed to collect tax at source. So if you come across any case where on the same transaction, buyer is also required to deduct TDS and seller is also required to collect TCS under 1H. Okay, I'm making it very clear that this slide is only for TCS under 1H of 206C. If it is a TCS under some other provision like scrap, etc., the conclusion will change. And therefore, in this particular case, the clarity is that only buyer will deduct TDS. The seller will not collect TCS, provided buyer has actually deducted TDS. So how are you applying? How are you going to apply these provisions at the field level? If I am a buyer, if I am buying goods, of course, I'm assuming that my turnover of preceding financial year has exceeded 10 crores. So I'll check applicability of TDS only at my level. Who is the seller? And in the hands of seller, whether TCS is applicable or not, I'm not supposed to see anything further. Once again, I'm clarifying that I'm talking about general goods to which 1H of 206C is applicable. So in this particular case, if I am a buyer, I'll check applicability of TDS at my level, whether my turnover of preceding year is exceeding 10 crores, whether the total of all transactions of purchase of goods which I have entered in with you, whether this total amount is more than 50 lakhs. If yes, I'll start deducting tax at source. Very simple. Now let's understand the same situation from seller's point of view. Now, if I am a seller and I am selling goods to you, then I have to first check applicability of TCS at my level, whether my turnover of preceding year was more than 10 crores, whether I'm receiving the total amount of consideration from you in this particular year, which is more than 50 lakhs. If yes, I am supposed to apply TCS. I am supposed to collect TCS from you, but just wait. Don't proceed to collect TCS. Now you further check the status of the buyer, the person to whom you are selling the goods, whether the buyer is supposed to deduct tax at source from your transaction in which you have sold goods to him, because this new provisions of 194Q with effect from 1st of July 2021 might become applicable to him. Check the status of the buyer, whether he is required to deduct tax at source. Merely because he is required to deduct tax at source is not sufficient. He has to check further that whether he has actually deducted tax at source on your transaction, because both of these conditions are required to be satisfied. If you read 1H of 206C, it will make it very clear that the buyer should be under an obligation to deduct tax at source, and actually buyer should have deducted tax at source. So you ask these two questions to your buyer, that are you liable for 194Q in this, the new provisions, and whether you have actually deducted tax at source on this particular invoice or not. And if he has deducted tax at source as a seller, this 206C1H is not applicable to you. You are not supposed to apply TCS. So friends, I know that it's going to be a very Herculean task, a challenging task at the field level. Imagine a case of an entity having huge turnover, huge volume. How are they going to apply this particular provisions that you check what is the status of the buyer and whether he has deducted and paid the, I mean, whether he has deducted TDS under 194Q or not. Even I have come across some of the cases under the existing provisions of TCS, which was inserted last year, is that irrespective of whether 50 lakhs was crossed or not, as a system, the person has started collecting TCS on all the transactions, sale of goods, because he says that I want to make my life very simple. I don't want to enter into this complication to see whether the 50 lakhs amount has crossed or not. And tomorrow I don't want to explain to the authorities that this particular part was exempt from TCS and therefore I have not collected TCS. And therefore, to make it very simple, the persons are starting, they have started collecting TCS from everyone. So perhaps in this case also the situation might practically turn out to be that each party will fulfill his obligation irrespective of entering into this complication. So now I'm coming to a subsequent slide where I'm trying to explain the specific goods like scrap, timber, alcoholic liquor, etc., where 1H is not applicable, but some other subsection existing provision of 206C is applicable, even motor vehicle of the value exceeding rupees 10 lakhs. In this case, only seller will collect TCS and buyer is not supposed to deduct the tax at source. CBDT is authorized to issue the guidelines, etc. So let me come to some of the issues now here. So the first question is that whether the TDS is required to be deducted at source on the whole of the amount including GST or only on the amount excluding GST. Now, this issue is becoming very complex because otherwise, I was personally of the view that GST doesn't have a character of income for the purpose of Income Tax Act, and therefore it doesn't make any sense in asking any person to collect TCS on GST or asking him to deduct TDS on GST. But unfortunately, under that provision which was inserted last year, a circular number 17 was issued, and then that circular it was clarified that it will be the total amount of consideration, including indirect taxes like GST, etc., which will be taken into consideration for the purpose of applying TCS. And therefore, perhaps even for the purpose of TDS also, it is indirectly becoming clear that the same clarification will be extended even to TDS under 194Q. And for the government, 194Q is becoming a stronger case, is because if you read 206C1H, there was a reference to consideration, and therefore there was still a case to argue that consideration GST is not a consideration, but 194Q is making a reference to any sum and not a consideration, and therefore it is becoming a stronger case for the government. However, I'll be failing in my duty if I don't point out an old circular of 2017 in the context of all other provisions of TDS, wherein it was clarified that there is no requirement to deduct tax at source on the GST portion, provided it has been no in the contract itself it has been indicated separately. But in that circular there is a specific reference everywhere, not only to GST, but they are referring to GST on services. And therefore now the job of CBDT will be very difficult as to whether for the purpose of 194Q, whether they should clarify on line with circular number 17 of 2020, or they should clarify on line with circular number 23 of 2017. So only time will tell us as to how this particular issue will be clarified. This threshold of 50 lakhs, for the purpose of applicability, you need to consider your purchases even for the first quarter, though it is becoming applicable with effect from 1st of July 2021, because the threshold of 50 lakhs is for a year. Okay, now very important question, whether a non-resident buyer is liable to deduct tax at source if you are selling goods to a non-resident from here. So on exports, so for import, 206C1H is making very clear in the provision itself that TCS provision is not applicable. But here, if you refer to the provision, the pay should be a resident one, the payer need not be. And therefore the issue which is arising here is that whether a non-resident person purchasing goods from any Indian resident, whether the non-resident buyer is also liable to deduct tax at source at 0.1% under this provisions of 194Q. And if that is the case, I think we are making it too complex, for this imports and exports. And therefore that was the reason why I clarified that CBDT is, central government has been given a power to issue a notification exempting certain classes of buyer from the applicability of TDS. And therefore I am sure that all bodies are going to represent on this point, and clarification will be issued on that line that non-resident buyer should not be made liable for this TDS. Please keep a point in mind that if you fail in your duty to deduct tax at source under this provision, now 30% of your purchase consideration itself will be disallowable under the provisions of section 40A1A. This is something which is very important. What will happen to purchase of securities? Whether TDS will apply under 194Q? The answer is yes, is because in the context of TCS, they have clarified by way of circular number 17 of 2020 that if your transaction, sale of securities happening on the floor of a recognized stock exchange, or if it is cleared and settled through a recognized clearing corporation, only in that case the TCS was exempted. That means off-market transactions, or transactions of shares of some non-listed companies like private limited companies, etc. In those cases, TCS was indirectly made applicable by virtue of this clarification, and therefore a view is that goods will include securities for the purpose of this provisions, though as per GST Act the definition of good doesn't include this particular securities, but for the purpose of income tax it will. So I'm hoping that the same clarification will be extended. Whatever positions which were clarified for TCS on sale of goods will be extended to even for TDS on purchase of goods. Moving ahead on some other provisions of TDS. Now, this is once again, creating that big question in my mind, that are we once again moving in a direction of ease of doing business really, as far as the taxation provisions are concerned, more particularly income tax provisions. If we have provisions like this on the statute, I don't think that ever we can think over about ease of doing business to the extent we are being asked to apply this provision. So what are these new provisions, both for TDS and TCS? Friends, we know that today we have the provisions on the Income Tax Act, which says that for every transaction of TDS or TCS, you have to obtain the permanent account number of the other party to your transaction. Now the PAN or Aadhaar is being made interchangeable, that's fine. But if you don't obtain the permanent account number, 206AA is asking us to deduct tax at source as twice the rate or at 10%, whichever is higher. Now, perhaps our nation has come to a situation that majority of the people, wherever required, have obtained the permanent account number or Aadhaar number, but those people are not filing their ITRs. And therefore, now new provisions have been introduced. One more obligation, that just obtaining permanent account number is not enough. Now you go one step further and check whether those persons have filed their income tax returns or not. And if you come across a case, if you are dealing with a person, though having PAN number, but he is not filing his income tax return, then in that case, these two new provisions you have to take care of with effect from 1st of July 2021. 206AB for the purpose of TDS and 206CCA for the purpose of TCS. Now let's understand how these provisions are becoming applicable in a case where I am entering into a transaction with a person who is a non-filer. Now, here the deductee, if it is a TDS provision, deductee, if it is a TCS provision, a collectee, should be a specified person. So who is a specified person is something which is defined for this purpose. A specified person is that person who is not filing his income tax return. Now, this non-filing of ITR, the first condition of a specified person, we need to see vis-a-vis two immediately preceding assessment years. That person should have filed the return for both of this assessment years, preceding assessment years. If he has not filed the return for any of this assessment year, that person, the first condition will get satisfied, and for us, that person will become a specified person. So, for example, if I am entering into a transaction of TDS or TCS on 1st of December 2021, two immediately preceding assessment years are 2021 and 21-22. And therefore, here I need to see whether that person with whom I am entering into a transaction wherein I am liable for TDS or TCS, whether that person has submitted his ITR for both of these assessment years or not. If not, the first condition is getting satisfied. There are few more conditions. Next one, this status of non-filing of ITR, we have to see for 2 years, only for those 2 years for which the time limit to submit this income tax return for that person under 139(1) has expired. Friends, you are supposed to see the position of due date of ITR, not in your case. You have to see the due date of ITR for that person's case, deductee or collectee. Okay, so you need to know what is the due date which is applicable in the case of a person with whom you are entering into a transaction. Merely because there is a non-filer of ITR, that's not enough. It doesn't make any sense in asking you to apply this provision merely because that person is a non-filer of ITR. Is because might be possible that his income is not exceeding the basic exemption limit, and that is the reason why he's not filing the return. And therefore, in that case, why this provision should be made applicable? It's fair. And therefore, there is one more condition, that merely ITR status is not sufficient. If one more condition is satisfied, then and then only that person will become a specified person for you for the purpose of applying this transaction. And what is that condition? You are not only supposed to see what is the due date and accordingly decide whether for 2 assessment years for which the due date has expired, whether that person has submitted his ITR or not. You need to see further whether aggregate of TDS and TCS in that person's case should be 50,000 or more in each of those 2 assessment years. So in my example, if I'm entering into a transaction on 1st of December 2021, I am supposed to see the status of ITR filing for 2021 and 21-22. Merely because he has not filed his ITR is not enough. I need to see that whether the aggregate amount of TDS and TCS in his case, whether that amount is 50,000 or more. So it makes very sense. It is making a sense is because now we are taking care of a person in whose case the total amount of TDS and TCS has happened to be 50,000 or more than that. And in spite of this, he has not filed a return. And therefore, on a prima facie basis, it is indicating that it is a case where a person is having some taxable income, but in spite of that, he is not submitting his ITR for in his individual case. And therefore, after if you come across a case where your person, that is deductee or collective with whom you are entering into a transaction, is a specified person, you have to apply this provision. And if these provisions are applicable, what will be the consequences of this? The consequence of this is very simple. You will have to deduct tax at source, or you will have to collect the tax at source at the twice the applicable rate or 5%, whichever is higher, something which is similar to the existing provisions of 206AA or 206CC. It further clarifies that if you come across a case where 206AA or 206CC non-furnishing of PAN number is also applicable, in that case what you do is you apply higher of these two rates. So 206AA ka rate or the 206AB ka rate, higher of these two rate you need to apply. But I was just wondering that if that party doesn't give me his PAN number, then in that case how I am supposed to know whether he is filing the return or not? I am not having his PAN number at all. And therefore, where is the question that in a case I'll be able to know if he has not furnished the PAN number to me, to even further see whether provisions of 206AB is applicable also. And therefore, if 206AA and 206AB is also applicable, I have to deduct tax at source at higher of the rate of 206AA or 206AB. I don't know how this reconciliation would work. Fortunately, there is a specific exemption to a non-resident. Unless he has a PE, this particular non-resident will never be regarded as a specified person. Some of the TDS provisions are excluded. So salary, you don't deduct TDS at higher rate merely because your employee is a non-filer of ITR. Something, some more similar cases are winning from lotteries, etc., where even existing rate of TDS itself is higher, and therefore we are not supposed to apply these new provisions vis-a-vis some of the TDS provisions which I had listed in my slide. Now here let's understand how in practice this provision are becoming applicable. So the condition is that I have to see the status of ITR filing of that person for 2 assessment years, those 2 assessment years for which the due date in his case has expired, due date under 139(1). So I'm taking a very simple case that if I'm making some payment in July 2021, so at least I know that the earliest due date for filing of ITR is 31st of July 2021, and therefore for assessment year 21-22 that due date has not yet expired, and therefore what I'm going to see is the status of ITR filing in his case for AY 19-20 2021. I know that there will be a big question mark in your mind that how I'm going to know that whether he has filed his ITR or not. Am I supposed to ask this question to that particular person? Just keep this question for a moment aside. I'm going to point out some of the practical procedure which is available. So here what I'm supposed to see is the status of ITR filing in the first case of payment in July 21 for 1920 and 2021. Now, if let's say I am entering into some transaction whereby I am supposed to make some payment in the period from August 21 to October 21. Now, which 2 assessment years I am supposed to see? Because this is a period where different due dates are available, 31st of July, then 31st of October, etc. And therefore, now I am supposed to further see whether that person is liable to audit, and therefore the due date in this case is not 31st of July but 31st of October, and therefore depending upon what is this due date, I am supposed to ascertain which 2 years I am supposed to take into consideration. This is a difficulty of an virtual meeting and online presentation. I'm not able to see the reaction of the audience here. If we enter into a next transaction in January 22, once again that position will be simplified because now all the due dates have gone, and therefore now I'm supposed to see the status not of 1920 but 2021 and 21-22. Fine, this is not enough. Now You must have realized that with the help of this example, that the same person with whom I am entering into a transaction, his status might change from a specified person to a non-specified person during the same year. So in the same example which I pointed out, if in earlier payment of July 21, if assuming that he had filed the ITR for both year 1920, 2021, and therefore I did not regard that person as a specified person, and therefore I deducted tax at source at a normal rate. But when it came in January 22, he had not submitted his ITR for 21, 22, and now therefore at that point in time he is becoming a specified person. So the status might change during the same year for the same payee or collectee. And therefore the question is that whether all my past transactions now I have to change, whether I have to consider that person as a specified person with respect to even my past transaction. The answer seems to be no, but there is no clarity as far as this point is concerned. As far as this aggregate amount of TDS and TCS, you were wondering as to how I would come to know as whether that person has submitted his ITR or not. That's not enough. You have to ask him as to what is your total TDS and TCS, whether that was 50,000 or more. So the question here is that whether for applying this threshold of 50,000, am I supposed to see only my transactions with him, or am I supposed to see this threshold of 50,000 in aggregate in the case of that pay, considering all TDS and TCS, even which has been deducted by all other parties? So am I supposed to ask a copy of 26 years from that person, whether he's going to share this kind of secret document with me? The answer is obviously no. And therefore, what I feel is that today, under the Act, we have a similar provisions of 194N, which is applicable for TDS on cash withdrawals by the bank. And what the income tax portal has done is that in the income tax portal, this utility has been provided, verification of applicability of TDS under section 194N. And there what you are supposed to do is that you put your PAN number, I mean PAN number of that person for whom you want to know the status. Just to tell you that 194N is also providing different rates and different thresholds depending upon whether that person to whom the cash withdrawals have been paid by the bank, whether that person is a return filer or a non-filer. And therefore, for the purpose of ascertaining this threshold and rates, this utility has been given on the portal for the bank. You can also access this utility. The PAN number of that person is required to be entered. You enter your mobile number, not the mobile number of that person. And once you enter this mobile number, OTP will come to your mobile number. You enter that OTP, and once you enter this, you will be shown the status of that person. So for 194N, different kind of provisions are applicable. So the first one is a screenshot where that person happened to be a filer, and the second one is a case of a person who happened to be a non-filer, and you can see the change in the rate. In the first one it was 2%, and in the second one it was 5%. And therefore the portal will tell you the status of your deductee or collectee. So you need not ask these details. Perhaps this utility will further be extended for the purpose of applying 206 AB or 206 CCA. That is how I am assuming. But in spite of this, the point here is that are we supposed to do this onerous task of verifying what is the status of each and every deductee and each and every collectee, and that too while entering into each and every transaction? Because as I pointed out, for the initial part of the year he might not be a specified person, but in the later part of the year he might become a specified person because he has not submitted his ITR for the last assessment year for which the due date is just ended. So I'm very sure that this is going to be a Herculean task, or rather, I can say to an extent that is an impossible task to be performed for entity having huge volume. Nevertheless, we will have to proceed further for the other amendments of TDS. So one more provision of 194P has been inserted, and it has been represented. This is something which is resulting into some kind of bonanza for the senior citizen. Let's understand how. So 194P says that this is something which is applicable only in case of a specified senior citizen. Who can be a specified senior citizen? I'm going to deal with that in the subsequent slide. So in case of the senior citizen, a specified bank, so certain banks will be notified for this purpose. Every bank will not become a specified bank. The specified bank is going to compute the total income of that senior citizen. So the bank is now supposed to know what all different provisions of Income Tax Act are applicable for the purpose of computing income of the senior citizen if he's approaching the bank. after giving effect to all deductions and rebate, etc., compute the tax liability of that senior citizen at the rates in force. So slab rates are required to be applied and total tax liability is required to be computed. And after that, this total amount of tax liability will be deducted by that specified bank in the form of TDS, because this bank is supposed to make several payments to that senior citizen. So that is how the mechanism is. Now, who can be a specified senior citizen for this purpose? Now, before I deal with this, let me tell you the background. What is the reason? Let me go to the subsequent slide. The reason for providing this particular mechanism is that it has been told in the provision that if the bank is adopting this particular procedure in your case, and bank is deducting whole of your TDS from your payments, in that case, that senior citizen should not file the income tax return. And I'm repeating the sentence that senior citizens should not file the income tax return. So even on a voluntary basis, they have been denied filing of return under section 139, because it has been mentioned in the provision of this new TDS provision is that the provisions of section 139 shall not apply. So you cannot upload a return at all. So basically the idea is to give a procedural exemption to the senior citizen that you did not submit your return and your obligation will be taken care by your bank. So for the purpose of extending this benefit, who all can be the specified senior citizen? The one who is resident in India, having age of 75 years or more. So now we have one more criteria of age. We had 60 years and 80 years. Now we have 75 years for this purpose. I don't know why not 60 years. Further, it says very interesting condition that the senior citizen should be having only specified income and he should not have any other income, because the bank has been asked to compute his income. And therefore, if, for example, if the senior citizen have some capital gain, it will become too complex for the bank to compute the capital gain and exemptions and several other things. And therefore, in order to have that simplification, there is a condition that senior citizen can have only these two specified incomes. And what are those specified income? Number one, pension, and second, interest from any bank account, and only that account which is maintained with that specified bank. So senior citizen is being debarred from having bank account with any other bank which is not a specified bank. He need to have a bank account for the purpose of getting interest only with that specified bank. He need to have only pension and only interest from that account, nothing else, nothing more than that, in order to become qualified for this purpose. So I don't know how many number of senior citizens would be able to satisfy this condition. And then further he says that this particular new scheme is not a mandatory scheme, and therefore if you want to opt in under this particular provision, the senior citizen is supposed to furnish a declaration to the specified bank in a form to be prescribed. Fine. So the several issues which are arising over here is that the objective is to give a procedural relaxation to the senior citizen. Now, my question over here is that whether filing of ITR would be simple for a senior citizen, or go to a bank and submit the declaration and deal with the bank will be the simplest task for the senior citizen. I'm just leaving it to the senior citizen to decide which one is more simple for them. Then there are several other procedural issues which I'm not going into the detail. Yes, so this is something which is becoming very relevant. 115 BAC, which is now becoming effective from AY 2021, wherein the lower slab rates have been given. Whether this optional scheme of computing taxation under 115 BAC, will it be available under this particular provision? The technical answer is no, is because new provisions of TDS is asking specified bank to deduct tax at source at rates in force, and the rates in force are the normal slab rates which are applicable. The rates which have been given 115 BAC have not been incorporated in the definition of rates in force, and therefore in a way we are denying that senior citizen of that benefit of availing the lower taxation, if at all, if that is the case under section 115 BAC, unless they come out with some kind of a clarification. And just last issue, let me raise this, that whether that senior citizen will now be regarded as a non-filer of ITR, because if you put that PAN number in that utility, definitely I believe that the answer from the portal would be that there is no return which is existing against that PAN number, if at all that senior citizen has opted for this particular scheme. And therefore, now whether the banks are supposed to apply the new provisions of deducting TDS at a higher rate, because eventually that senior citizen is going to become a non-filer of ITR. All those issues are required to be addressed properly on the part of the government. Let me move on to some other amendments. So let me deal with some of the procedural amendments. If the firm is subject to a transfer pricing audit, in that case, the firm's ITR due date was 30th of November. Now partners due date is also aligned with that due date, and therefore now partners are also allowed to file the ITR by 30th November if their firm is subject to transfer pricing audit. This is something which is very important for all of us to know: belated return and revised return. Today the time limit was till the end of the assessment year. If you have missed the due date, you can still file your ITR by the end of the assessment year, that is 31st of March, and you can still revise your return if there were some errors or mistakes by, once again, 31st of March. Earlier you will recall that for revising of return, we in fact had one more year. We were allowed to file a revised return within 1 year from the end of assessment year. Before few years that was reduced till the assessment year, and now today, as per this finance bill amendment, the time limit for both of this, either whether it is a belated return 139.4 or revised return under 139.5, this time limit has been reduced by 3 months. And therefore this belated return, if you have missed the due date, you can now submit till only till 31st of December, and even revising of return is possible only till 31st of December. This is applicable from the next assessment year to come, that is AY 21-22. But I'll not be able to stop myself from clarifying that if you see the wordings of the amendment, it is resulting into a funny situation. They have worded this amendment in a manner which is exactly providing the opposite meaning. And let me read the amended provision. I have replaced the amended words over the existing words in 139.4, and it reads that any person who has not furnished a return within the time allowed to him under subsection 1, that is the normal due date, may furnish the return for any previous year at any time within 3 months prior to the end of the relevant assessment year or before completion of the assessment, whichever is earlier. We are not concerned with the latter part, but if you really understand the portion which is given in red, the time limit to furnish the belated return is at any time within 3 months prior to the end of the relevant assessment year. And whatever I could understand from this simple English language is that I am allowed to file belated return only within these 3 months prior to the end of relevant assessment year. So my end of assessment year is 31st of March, and within 3 months prior to this 31st of March, that means 1st of January till 31st of March. So I am being allowed under the amended provision to submit my belated return or even this revised return if there is an error only within these 3 months. So I hope that this particular errors has been noticed by them and they make the appropriate changes in this language. So this is just a snapshot of all the due dates. I'll not be repeating this because now our life is becoming complex. We need to have one dedicated cell in our office, one dedicated person just to keep a track of all the due dates, because quite often there are a number of changes which are taking place in the due dates every now and then. But just one point to be noted over here is that for the purpose of revising of return, if there are any errors or omission, we have been given very, very limited time. If audit is applicable, your due date itself is 31st of October. If transfer pricing audit is applicable, your due date itself is 30th of November. And if there are any errors or omission, you have been given a time only till 31st of December to revise your return. We know that in several cases today, what used to happen is that we used to receive intimation from CPC, and after realizing that there were some errors because of which CPC has made some adjustment, we were revising those return, and now that possibility seems to be not there unless CPC comes out, immediate processing of ITR. Pre-filled ITR, we don't have any corresponding amendment in the act. This is something which was clarified by way of a budget speech, and it was clarified that now only your data, not only your data related to salary or TDS, etc., which will be pre-filled in your ITR. Wait and watch. Now you will have pre-filled ITR having your capital gain details from listed securities, details of your dividend income, details of your interest from banks, etc. And I was surprised when I read the interview of the revenue secretary, in which he clarified that even the details of GST will also be pre-filled in the ITR. We know that today in ITR, for the purpose of filling P&L, balance sheet, etc., at several places we have to fill the data related to GST, etc. He clarified in his interview that we are going to even pre-fill those details of GST in the ITR. The time limit to send intimation under 143(1) is also reduced by 3 months. So now it is only 9 months from the end of the financial year. Processing of ITR, some of the powers have been amended, more powers have been given to CPC. As per the existing provision, the scope of adjustment for the CPC was that if CPC comes across a case where some disallowance of expenditure has been reported by you in your tax audit report, that expenditure could be disallowed. But what if you, as a tax auditor, if you are reporting some increase in your income, increase in the income of the SSE? So since the wordings of 143(1) were such whereby it was referring only to disallowance of expenditure, CPC was not able to make the adjustment for increasing in income which has been reported in any tax audit report. So in tax audit today, we are supposed to report under so many clauses like section applicability of section 56, etc., where it has an effect of increasing income. And therefore now a suitable amendment has been incorporated that CPC not only will disallow your expenditure, but make the adjustment for even increasing the income if at all it has been reported in your tax audit report. And the second one and the last one, with respect to scope of adjustments while processing of ITR, is that we know that chapter 6A part C, only profit linked deduction. I'm just referring to profit linked deduction. I'm not referring to deductions like ATC, ATD, etc. All of these deductions are available subject to the condition that we file the ITR on or before the due date. And if it not, then this disallowance or these deductions are not permissible. But 143(1) was allowing CPC to make the adjustments by disallowing these deductions, not any of these deductions, but only those which have been referred in provisions which are being reproduced in my slide, which were namely ATI, IAB, etc. So for example, a cooperative society, and this was very common in case of cooperative society, if cooperative society while filing the ITR claimed a deduction under section 80P, and many of the cases they missed out of selecting a particular provision in the ITR. They have to select that we are liable for an audit under the relevant Cooperative Societies Act, and therefore CPC did not realize that this cooperative society is also liable for audit. And therefore, if the return was filed after 31st of July, CPC took a due date as 31st of July, denied deduction of ATP, which was basically not within the powers of the CPC, because ATP was not referred here. And therefore, now the provisions have been amended, allowing power to CPC to disallow any of these deductions which are referred in Part C of Chapter 6A if the ITR has not been filed within the due date. Defective returns, we know that many of the returns were being regarded as defective. Notices were sent. We were flooded with those notices from CPC that your return is becoming defective under 139(9). And now officially also they have admitted this particular position in the memorandum, that this was creating difficulties not only for the taxpayer, but it was creating difficulty for the department as well. And therefore there is a proposal that notification can be issued whereby some of the conditions can be relaxed, that even if those conditions are not satisfied, your ITR will not be regarded as defective only because of that reason. So we don't have any further details, and therefore we cannot discuss this in more detail. We'll have to wait for the notification to understand what all conditions will be relaxed. Notice to non-filer, if you have not filed your ITR within the due date, today the assessing officer had only the powers to issue a notice to you asking you to submit your ITR. And now we know that everything is virtually becoming faceless under the Income Tax Act. Assessing officer is only for the namesake. We can say to that extent. And therefore, there is a corresponding amendment in 142(1) that prescribed IT authority is also given a power to issue notices. And therefore, what is going to happen? The centers like NESA will pick up the data that who all have not submitted that return, and the notices will be issued from a system wherein one of the prescribed IT authority is going to put his digital signature, and all those notices will be becoming valid notices for the purpose of 142(1). Let me come to the assessments, friends. I am on bank 7. I have 15-20 more minutes to deal with further amendments. I am halfway. So this particular assessment procedure, there are a lot many changes. Even nearby also pointed out this particular change, and therefore what I'm going to do is that I'm going to give you a broad overview of the change in the assessment procedure. And if we want to know in more detail, in fact, we need an exclusive session only to understand this change in the assessment procedure. And I hope you all are fine with this. So CBDT chairman said in an interview that now only information based assessment is going to take place, and therefore it is going to help to reduce the harassment of the taxpayer. And I'm happy to note this is because indirectly it has been admitted that today there is an harassment of taxpayer to some extent. Okay, nevertheless, scrutiny notices for the purpose of selecting your cases for the regular scrutiny 143.2. Today, we have a time limit of 9 months. So by 30th of September, from the end of the year in which you file the return, these notices could be sent. There is a proposal to reduce this time limit from 6 months to 3 months. Sorry, I think I referred 9 months. The existing time limit was 6 months. There is a proposal to reduce it from 6 months to 3 months. So it will be by 30th of June, notices is required to be sent. There is a slight change because of the Taxation Relaxation Amendment Act, and because of which what is happening is for AY 1920, the time limit for selecting cases and sending notices under 143.2, which was expiring on 30th of September 20, it stands extended up to 31st of March 2021 because of this COVID relaxation. And from 2021, now it will be only 30th of June, only 3 months. The time limit to complete the assessment and passing of the assessment order under 153, this is also being reduced by 3 months. So today we had a time limit up to 9 months, up to 12 months. The assessment could have been completed by 31st of March if it is assessment pertaining to AY 2021. But for the purpose of assessments pertaining to AY 2020, 21, 22 and onwards, that time limit is now reduced by 3 months, and therefore assessment can be completed only by 31st of December. So this is just a snapshot of what all different kinds of time limit which will be becoming applicable. 1819 assessments are in progress, that is required to be completed by 31st of March 21. 1920, the time limit as per the law is 12 months, and that will also expire on 31st of March 2021. But that relax when the Atmanirbhar package was announced, there was a proposal that those assessments which are becoming time barred by 31st of March 2021, the time limit will be extended by 6 more months, and the time limit will be 30th of September 2021. But I could not look at any corresponding amendment to the act to this effect, and therefore unless there is an amendment which has been brought in the act, the time limit will be as of now is 31st of March. So 2 assessments are required to be completed unless it has been extended. 2021 it continues to be 12 months. From 21-22 it will be now 31st of December every year within which the assessments are required to be completed. So this is just a quick snapshot. I'll not be repeating further, but you can see now time limit is reduced everywhere. So as far as the taxpayer is concerned, he's supposed to complete his filing of ITR, whether it is belated revised by 31st of December of that assessment year. And as far as department is concerned, department is also being asked to complete everything, whether it is intimation or assessment order, once again by 31st of December next to the assessment year. And therefore January to March is the period which is available for the department to attach the bank account and make recovery of taxes wherever required. Now I am coming to that particular change which Nearby had pointed out, the change in the assessment procedure for search assessment and reassessment. For the purpose of search, today we have special provisions taking care of all assessments in search cases, and they are 153A to 153D. So I'll not go into the details what provisions were today, but the assessment was, it was possible for the assessing officer to make the assessment of past 6 years in any case of search or a requisition, and even in some of the special cases from 7th to 10th year also. Now, under the amended provision, the special procedure of search assessment has been totally discontinued for any search which is taking place on or after 1st of April 2021. So there will be an assessment, but not under the special procedure for search assessment. The procedure for making an assessment in search cases now has been merged with the reassessment procedure, which is applicable in any case, reopening of the assessment. The existing provision of reassessment has also been amended fully all sections of procedural provisions dealing with reassessment have been substituted by new provision. We have one more new provision, which is 148A, and all of these are becoming effective from 1st of April 2021. So what are the features of this? Very soon we are going to realize when I move on to the subsequent slides. So the primary provision first, section 147, and here the provision, primary provision remains as it is. The assessing officer has been given a power to make the assessment or reassessment. Though I'm referring to the assessing officer, but even for the purpose of reassessment, a faceless procedure of making reassessment has already come in the act by way of that relaxation act, which was notified in September 2020. The only change, if you notice, in this primary provision is under the existing provision, we had a phrase reason to believe, and all of us would be knowing that there were a lot many disputes which had arisen as to whether in this particular case can it be said that the assessing officer has reason to believe, and therefore whether he can make a reassessment or not. And keeping this point in mind, this particular prerequisite for making a reassessment that assessing officer need to have reason to believe has been done away with. Now the provision is not referring to any kind of reason to believe. It simply says that the assessing officer can make the assessment or reassessment of any income which has escaped the assessment, but subject to the procedure which is laid down in 148 to 153. So does it mean that assessing officer has been given an endless power because there's reason to believe has been omitted? The answer is no. Only this phrase which was causing many difficulties for the revenue, that has been discontinued, but some of the safeguards have been laid down in those provisions of new provisions of 148 to 153. There is an explanation which has been continued, but with new words, which says that assessing officer will be able to make the assessment not only on the main issue for which the income had escaped the assessment, but if any other issues, if he is coming to know about those other issues during the course of the proceedings. So how the new procedure of reassessment is going to work? What will be the flow of this? We have different provisions, and I'm going to deal with each one of this quickly. I'm just going to give you a broad overview. So the first, instead of reason to believe, what is needed now? So what can be a trigger point for the purpose of reassessment? The trigger point for the purpose of reassessment is there should be an information with the assessing officer which suggests that income chargeable to tax has escaped the assessment in any particular assessor's case. And this information which is suggesting this, that income chargeable to tax has escaped the assessment, is something which is defined in this amended provision itself. And what does it mean? It means either of these two things. The first one, any information. So information means an information. It's a little funny, but that is how it is. It says any information which is flagged in accordance with the risk management strategy formulated by CBDT. So what I understand from this is that now it will be a totally system driven reassessment which will be taking place. We used to see a case where we were going to the department and the assessing officers used to give a threat that I'm going to reopen your assessment for all your past 6 assessment years. And now perhaps that subjective powers which were available with the assessing officer, they have been discontinued. The assessing officer will be able to reopen the case, and only in those cases wherein in his system he is able to see that flag in that assessee's case that there is some information which is existing which suggests that income chargeable to tax has escaped the assessment. So what is going to happen practically, what I can envisage is that if there is a search which has taken place in the builder's case and some registers have been found which says that on money in cash have been accepted from this kind of buyers, then this particular data is first required to be taken in the system by the department, and then system is going to raise a flag over all those assessees, and then respective reassessment will be undertaken by the respective assessing officer. Alternatively, that information can mean the final objection which has been raised by the audit department of CNAG. So now there is a complete clarity that if moment there is an audit objection, the assessing officer can straight proceed further for the purpose of reassessment. Earlier we used to have some difficulties. Now once he has an information, he has been given a power, but obviously that he can make any necessary inquiries if he want before proceeding further. There is nothing more in this. This is something which is very important. Today what was happening is that when the assessing officer has reason to believe, he was just supposed to record that reason in his order sheet, and he was given a power to proceed for the purpose of issuing a notice under section 148. Now under the amended provisions, that is not the case. Perhaps indirectly they are bringing that procedure which was laid down by a Supreme Court in the decision of GK drive shaft, in which it was said that SSC should be given a copy of reason, SSC should be given an opportunity to raise the objection. If the objections have been raised, the assessing officer has to pass an order in writing before proceeding further. Something which is similar of that sort has now been provided expressly under the provision. And what is it? It says that assessing officer cannot just proceed directly for issuing notice under 148. First, he will have to issue a so cause notice to the SSE, requiring him to explain as to why a notice under 148 should not be issued. So one notice, so cause notice, asking him to explain why another notice should not be issued on a mandatory basis. And the SSE has been given an opportunity of being heard at that stage itself. So you can, at that stage, you can point out that, look, this information is not relevant in my case, or for XYZ reason, this reassessment is not required to be done. And if the assessing officer is satisfied, he has also been given a power in this decision-making process that your reply will be considered. And on that basis, the assessing officer will have to pass an order, first deciding whether it is a fit case for the purpose of making a reassessment and whether a notice under 148 should be issued or not. And copy of that order will also be served along with the notice under section 148 if at all he is proceeding further. And this is subject to a prior approval to be taken by the assessing officer from a specified authority, and that too in a time bound manner. I am not just mentioning what are different time limits which are applicable. And then he will be able to proceed further for the purpose of issuing a notice under section 148. And from here, the procedure remains the same. There is no change with respect to a new procedure as compared to what the procedure which we have in response to 148 notice. We will have to submit the return of income, and then it will be considered as if it was a normal return of income required to be submitted under section 139. So the procedure just now, till now, whatever we had discussed is applicable not only for a normal reassessment, but is also applicable for search and survey cases. As I mentioned, the special procedure to conduct the assessment in case of search has been discontinued, and it has been merged with this, but with some variations. So what are those variations? Let us quickly deal with those variations. So first case of search. So in any case where search has taken place on or after 1st of April 2021, in the SSS case itself, or in someone else's case, the search has been conducted, but the assets, documents, books, etc. related to SSE have been found. In this case, as I had mentioned, for the purpose of reassessment, the assessing officer need to have an information, a piece of information. But here, because the search was conducted, that particular requirement is not applicable, and therefore the search itself, it will be deemed that the assessing officer had the information. So we need not have any flag in the system suggesting some information. Moment the search has been conducted, the assessing officer will be able to proceed further on the basis of deemed information, but only for 3 assessment years. If he wants to reopen beyond 3 past assessment years, in that case, he will have to have a specific flag, a specific piece of information only beyond 3 assessment year. For past 3 assessment years, it is deemed that the AO has the information. And one more variation is that assessing officer need not go through that whole procedure of 148A, giving so cause notice as to why I should not issue a notice under 148, etc. That is not relevant. Assessing officer can straight proceed further for the purpose of reassessment. Survey case is also being referred specifically. An exception has been provided, similar to search, that if there is a survey on or after 1st of April 2021, in that case, it is deemed that the assessing officer has information for past 3 assessment years. And therefore, now if there is a survey, the assessments will be conducted on a mandatory basis for the past 3 assessment years. Beyond 3 years, he will have to have the some or the other information. In survey case, he will have to conduct that particular process of issuing a so cause notice before he proceeds further. There is no exemption for survey cases from that procedure which we had in the search case. Conveners, I am nearing to 7:15. Just let me know how much more time I should deal with?
Sure, sir. Give it to me.
So I'll continue with this, but you can stop me in between. And
Yeah,
yeah,
that's okay, sir. If you can time it in such a way that in next 15 to 30 minutes we can wrap up the things.
okay. Thank you
15 to
so
30
much.
minutes. That.
Thank you so much. Thank you so much. So I'm just coming near to end for dealing with important amendments. My presentation is having around 140 slides. The idea was not to deal with each and every amendment which are there in my presentation. The idea was to just share my thoughts through my presentation on some of the amendments which I thought may not be applicable at mass level. But if you want to refer to some of the issues or some of the intricacies of those other amendments, they are available in my presentation, which you can refer on your own. So idea was not to run the whole of the presentation having this 140-45 slides. Okay, so the time limit is being reduced, and this is something which is very important for all of us to know, is that presently for the purpose of reassessment, we have a normal time limit of 4 years. And there are exceptional time limit of 6 years is applicable if the escaped income is 1 lakh or more, or even up to 16 years, the assessment could be reopened if the escaped income was relatable to foreign assets. This was for reassessment. For search assessment, as I had mentioned, the time limit was mandatory assessments for 6 years, and beyond 6 years up to 10 years, provided the escaped income was 50 lakhs or more. Now just see what the change which has taken place. So now under the amended provision, we don't have two types of assessment. We have only one, reassessment. Even for search, this will be assessed under the normal provisions of reassessment. And the time limit for the purpose of reopening of the assessment is in any case is just 3 years, not beyond 3 years. So now whether there is a search or whether it's a normal case of reassessment, beyond past 3 assessment years, your assessment can never be reopened by the income tax department. But in some of the exceptions, the time limit beyond 3 years is available up to 10 years, provided your amount of escaped income in that relevant year is 50 lakhs or more than 50 lakhs. Please note that this threshold of 50 lakhs is applicable qua that assessment year. So if the assessing officer has conducted a search and he found some of the evidences which suggest that I had some undisclosed income of 50 lakhs or more for the seventh past year, in that case he can reopen only for that seventh year and pass 3 years on a mandatory basis, but not for any other assessment years. So this is how you can see, from one angle you can see the time limit has been reduced, is because it was otherwise 6 years and now it has been made 3 years. But from the other angle, the time limit has also been increased with respect to those exceptional cases where the escaped income is 50 lakhs or more. This is nothing but explaining the same time limit. There is a transition provision which is also being provided favorable to the SSE, which says that after this new particular procedure is coming into effect, with effect from 1st of April 2021, in that case, under the new provision, the department has not been given a power to reopen the assessment for any of the past years if under the old provision, the time limit for reopening had expired. So what do I mean? Now let's take an example for AY 1415. For example, on 1st of May 2021, after the new provisions are coming into effect, the assessing officer is coming across some evidence related to AY 1415, which says that my escaped income was more than 50 lakhs. Now, under the new provision, the power has been given for such cases of more than 50 lakhs to reopen the cases for 10 years. And therefore, it was possible. But because of this restriction, the department will not be able to proceed further, because under the old provisions of reassessment, my assessment could be reopened only within a period of 6 years. And those 6 years have already expired on 31st of March 2021 vis-a-vis assessment year 1415. So that's a beneficial provision which is applicable. How different time limits will apply with respect to several years, I have given for your information. Just make a note of one point, that 31st of March 2021 will be a very crucial date for the income tax department. A lot of things are required to be completed by the department. We have done our job as far as our due dates were concerned. Now it is turn of the department, and let's see how they are able to complete all of their duties by 31st of March 2021. If you see my table on the slide, for 3 assessment years, 15 16, 16 17, 17 18, the time limit for sending notices under 148 are going to expire on 31st of March 2021, unless they are further extended. And here, of course, I am assuming that the escaped income is more than 50 lakhs. Prior approval things, etc., are not very important for us to discuss, and therefore I'll just leave this in the slide for you to refer. Okay, let me come to faceless things. So what has been made faceless so far, just for our information, till the last Finance Act, only assessment, first appeal and penalty, only these three proceedings were made faceless. Now during intervening period, that Taxation Relaxation Amendment Act, which was notified in September 2020, all other proceedings which you see on my slide have been made faceless. And if you see my slide, you will realize that nothing is left. Virtually each and every procedure, there is a provision under the Act whereby a scheme for completing this whole of procedure in a faceless manner without any interaction between the taxpayer and the tax department can be notified by the government. And looking at the speed at this things which are getting implemented, I am very sure that very soon we will be experiencing those schemes coming into effect. And now further, as nearby has pointed out, even the appellate proceedings before ITAT, which is a final fact finding authority of this under the Income Tax Act, has also been made faceless, and scheme may be notified for this purpose, which is coming into effect from 1st of April 2021. Please note that it is not the case that immediately from 1st of April 2021, all appellate hearings will be taking in a faceless manner. The power has been given to notify a scheme from 1/4/21. So it will depend finally on the scheme that from which particular date this ITAT hearings they are implementing in a faceless manner. I don't want to comment on this objective of faceless, etc. But just one point which I always wanted to bring to notice of everyone, that it's fine that we are making all this procedure faceless, but in wake of this particular implementation of faceless, it should not result that the authorities who are supposed to listen to us, they are also becoming earless. So we should be heard in a proper manner, though in a faceless scheme. Coming to some of the alternative dispute resolution, I just quickly refer to this, is that here there is a provision which brings a new resolution scheme under the Act itself. So we saw Vivad se Viswas scheme, and therefore on a similar basis, now there is no need to come out with a special scheme every now and then. In the Act itself, there is a scheme. So what is that scheme and how it is going to work? So this scheme is applicable only in some of the specified cases. If in your case your order passed becomes a specified order as per this provision, and therefore which order can be considered as a specified order is the order wherein the total amount of additions to your income is not more than 10 lakhs, and your returned income should also not be more than 50 lakhs. Only small cases are being targeted under this alternative mechanism for dispute resolution. It should not be a search case, survey case, or where DTAA information has been received. How are you going to get the benefits under the scheme? The provision says that this committee before which you are approaching under the scheme has been given a power to either reduce or waive the penalty which could have been levied otherwise, or the prosecution which could have been launched. The committee has been given a power to grant even immunity from the prosecution which otherwise could have been launched. There's no clarity as far as whether you are going to get any other benefits apart from immunity from penalty or prosecution. Like, will there be any waiver of interest? Will there be any concession in the amount of tax which is charged? I don't think there will be any concession as far as the tax amount is concerned. What is the timeline within which I'm supposed to pay? Whether I'll be allowed to go in an appeal even after I have gone under the scheme, or this is an alternative to appeal. So we need to wait for all those clarifications. Settlement Commission has been done away with immediate effect from 1st of February 2021. Pending applications will be handled by an interim board. AAR is being replaced by BAR. It's not just that letter A is being getting replaced by B, but there's a whole change in the constitution. AR presently was constituted by, I mean, chairman of AR, etc., by retired judges of the courts. Now there is a proposal to constitute BAR in place of AR, which will be consisting of persons coming from the department, that is chief commissioners, etc. And with this, now I am entering into a last part of my presentation, the provisions dealing with the changes with respect to depreciation on goodwill. We had a Supreme Court decision in the case of Smith Securities Limited, which held that if at all there are any goodwill which are booked in the books, which is arising due to the effect of amalgamation, it becomes eligible for the purpose of depreciation. And subsequent to the Supreme Court decision, some of the disputes were arising because of IT decision disturbing this particular position. We have dealt with this controversy in BCA journal. Someone interested can refer to this. My job is to now, due to limitation of time, to point out what all amendments which have been proposed. So the first amendment is an amendment in the definition of a block of assets. And there was a reference to all kinds of intangible asset. Now goodwill of a business or profession is specifically excluded from intangible asset. So goodwill is no longer entitled to enter the block of assets. 32(1), which is a proper provision dealing with depreciation, is also being amended to exclude specifically the goodwill of that business and profession once again from the eligibility to claim the depreciation. So both of this amendment clearly implies that goodwill is no longer entitled for any depreciation anymore. And though the background of this, I refer to the goodwill arising due to amalgamation, etc. But please make a note that this amendment is applicable to any type of goodwill, whether it is a goodwill arising from amalgamation, even in a case where you have purchased goodwill from someone else, even that type of goodwill has not been, has been made ineligible for the purpose of claiming depreciation. There is an amendment in section 50 as well as section 55 to take care of the existing goodwills on which you have already claimed depreciation so far. Please note that this provision is applicable with effect from 1st of April 2021, previous year 2021, assessment year 21-22. And therefore, if the goodwill was already there inside the block on which you have already claimed the depreciation on that amount of goodwill, this amendment is trying to take care of a scenario where upon subsequent sale of your goodwill, what should be your cost and how you should compute the capital gain. This provision, amended provision, says that in that case, the capital gain will be computed in a prescribed manner. So we need to wait and watch. Basically, the idea is that from total costs, to the extent you have already claimed depreciation, that much of cost is required to be reduced. And that is what coming out very clearly in the amendment which has been incorporated in section 55, which is defining cost of acquisition. The amendment is now specifically referring not only to goodwill of a business, goodwill of a profession as well. And further it says that if at all you have already claimed depreciation in the past prior to this amended provision, the total amount of depreciation you have already claimed is required to be reduced from the cost when you are computing your further capital gain. Only one of the issue which I thought that we should deal with at this forum is that agreed that depreciation has been made ineligible for, goodwill has been made ineligible for depreciation henceforth. But what about the existing goodwill which has already entered in the block? If you see the amendment, there is no proper amendment amending the computation of block of assets under section 43C. 43.6. So the computation of WDV is being provided in some different provision, and there is no corresponding adjustment or corresponding amendment to that provision. And therefore, whether you are supposed to exclude that WDV of goodwill from your block of assets so that you don't claim depreciation on the goodwill as per the amendment provision, there is no clarity. Howsoever, the problem is, but intention is very clear. It appears to deny goodwill in totality, whether existing goodwill or new goodwill, irrespective of this. But the problem is with respect to how do you adjust your block of assets. The last one which I wanted to deal with is 36(1)(5)(a) versus 43(b), employees contribution. So we know very clearly that 36(1)(5)(a) is dealing with employees contribution, 43(b) is dealing with employers contribution. 36(1)(5)(a) tells us that employee contribution you please pay within the due date of that PF or ESIC law. And if you don't pay within this due date, this particular employee's contribution, which has been regarded as your deemed income, is no longer entitled for deductions. 43B, which is applicable for employers contribution, gives us a very long time period, longer as compared to 36(1)(5)(a), and it says that it's fine if you are not able to pay within the due date of ESIC, PF or such any other law, but as long as you are able to pay your employer's contribution on or before the due date of filing of your ITR, the deduction is available. However, irrespective of this distinction between employees and employers' contribution, the courts have taken a favorable view that even with respect to employees' contribution, someone can apply the provisions of 43B and get a deduction irrespective of the fact that those employees' contribution were not paid on or before the applicable due date of that particular welfare fund. And these are the decisions which I have given in my slide. In one of the case, even the Supreme Court had dismissed the SLP which was filed by the department. There were a contrary view on the other side, and these are the decisions of the high courts giving that contrary view. Now, irrespective of this, now we have a very clear amendment in the law, making this position very absolutely clear. The explanations have been provided, inserted in both of these provisions, 36(1)(5)(a) as well as 43B, which says it begins that for removal of doubts, and therefore it is bringing that particular clarity in law. And it says that 36(1)(5)(a) in its place will apply to employees contribution, and you can't apply 43B provision for the purpose of ascertaining that due date, and 43B explanation says that you can't apply provisions of 43B for the purpose of employees contribution. And therefore the position is now that even if you miss your due date by 1 day, as far as these are the employees contribution, you will not get any deduction. This will be now a permanent difference and no longer a timing difference, and this is effective from assessment year 21-22. I know that the question will be arising that we have received number of intimations from CPC wherein this adjustments has been done on an automatic basis by CPC, and therefore if you are standing in an appeal or you have disputed that particular adjustment before any forum, what will be the position in the law, whether since this explanation has been worded for removal of doubt, whether it will have a retrospective effect or not. This issue is going to become very complex. One can refer to the Supreme Court decision of Vatika Township, which says that if the amendment is disturbing the existing rights and the amendment is not specifically providing having an retrospective effect, you cannot apply with retrospective effect. But nevertheless, irrespective of anything, my view is that even if you apply this amendment with retrospective effect, CPC at a point in time when it did the adjustment, at that point in time, the position was that there were high court decisions favoring me. And therefore, CPC was not having that power to make that adjustment because there were prima facie adjustments which were within the power of the CPC to make. And therefore certainly when a court is taking a view that this employee's contribution is entitled for a deduction under 43B, perhaps to my mind CPC was not authorized to make this adjustment. So now next part of the my PowerPoint presentation was dealing with that real estate, and I am sure that this amendment was already being announced through press release, and therefore I'll just skip this particular amendment for the purpose of our discussion. I'll just come to a couple of last amendments in just couple of 3-4 more minutes. The one is ULIP, because I think that this is something which is very important and hitting a lot of people. So in case of ULIP, the proposal is to deny the exemption in a case. So I'll come to the amendment proper. So the denial of exemption in a case where the annual premium payable with respect to your ULIP policy is more than 2,50,000. So in order to get the exemption under 1010D, your annual premium should not be more than this amount in any year of your terms of policy. Please don't plan to have different ULIP policies so that for each one of this, the annual premium is not more than the threshold and you want to enjoy the exemption. There is a provision to take care even of this scenario, which says that if you have multiple policies, in that case, you will be entitled for exemption only for those policies, the aggregate premium of which is not more than 2,50,000 in any year. So you need to apply this provision in this manner. And if at all your ULIP policy is not entitled for exemption, how will this be taxed? So this will be taxed under capital gain. This has been put on par with equity oriented fund. STT is made applicable, so you will be able to apply the beneficial tax rates of 111A of short term or 112A if this is long term. There are several issues which are arising with respect to this. For the want of time, I will not be dealing with this. Interest on provident fund exemption. So here there were shocking statistics which were revealed in the yesterday's newspaper, that only topmost HNI was having a balance of 103 crores in the provident fund, and therefore it was resulting into an undue benefit of exemption if whole of the interest on the PF balance, the exemption has been granted. And therefore a proviso has been inserted in both of these provisions 10.11 and 10.13, which says that with respect to interest, you can enjoy the exemption only to the extent of your contribution not more than 2,50,000. This is with respect to only employees' contribution, not with respect to interest earned on employer's contribution. So as an SSC, if my contribution in any year is more than 2,50,000, then interest which has accrued on this amount of more than 2,50,000 in future is not entitled for exemption anymore. And for this purpose, I need to see only my contribution on or after 31st of March 2021. So the balance as on 31st of March 2021, irrespective of how much my contribution was in respective years, continues to be entitled for the exemption. So that's all. LTC was also announced through a press release in the past as part of Atmanirbhar package. Now, only last two segment of my presentation, the second last dealing with trust. So this is very specific, and the last one dealing with miscellaneous. So I'm leaving this part of the presentation for to you to refer. If any questions, so thank you for patiently hearing me. Now, if there are any questions, I'll be happy to deal with those questions.
Yes, thank you so much, sir, for your detailed presentation on the subject. And before I hand over the proceeding to Dipen for proceeding with the question answer session, let me announce that tomorrow in the morning at 11 o'clock, we have another virtual CP meeting, which will be covering the impact of budget on capital market and analysis of indirect tax as from this budget. So that will be tomorrow from 11 to 1 p.m., 11 a.m. to 1 p.m. And the link is already open for the pre-registration. And now may I request Deepen to go ahead with the question answer session, please.
Thank you, Lalit bhai. The first question is regarding.
I'm sorry, I was not able to read and go through those questions because the flow in which I was running my presentation, I thought that let me keep this at the end. I'm very sorry for that.
Yeah, that's okay, sir. Absolutely.
Yeah.
Now continue.
So the first question is regarding senior citizen. If there is a refund arising on account of TDS being deducted, then whether they can get a refund without filing of returns?
So the scheme is designed in such a manner, Dipen, that the bank is going to deduct TDS only that much which that senior citizen was supposed to pay. As per the provision, bank is not supposed to deduct higher amount of TDS, and therefore there can never be a refund scenario. If by mistake bank has deducted TDS, what are you supposed to do? There is no answer to that question because technically speaking, that filing of return under 139(1) has been debarred. So what practically you can do is you can go on portal and upload a return, and irrespective what provision says you upload a return and you get a refund is a different matter.
Okay. Sir, another question is regarding TDS provisions. Whether TDS provisions would be applicable if individual or HAF, if books are not audited and having turnover of 2 to 10 crores.
Yes, it's because there was a corresponding amendment which was already being made, not through this finance bill, under the respective provisions of TDS, that instead of making a reference of turnover limit of 44 AB, the turnover amount itself has been specified in those provisions. And therefore, if your turnover is exceeding 1 crore as an individual or HF, you are always liable to apply wherever the TDS is required to be done, those provisions.
Okay. Next question is regarding section 6(1)(a) of the Act. An individual who is a citizen of India and having Indian source of income exceeding 15 lakhs is deemed to be resident in India if he is not liable for tax in any other country by reason of domicile or residency of any other criteria. The question is regarding the shippers who are on ship for more than 182 days, and they are
I
not.
think this. Can we skip this question because this is not arising out of any amendment? There is no amendment to 6(1)(a) in this finance bill, and this is a very specific case.
Okay. Next is regarding indexation. Will it be allowed to firms or on the value
Correct.
of?
So I understood this question. I had that question for 45(4) and 4(a). So the basic question first is that how do you determine that your asset is a long term? That's what I raised during the course of my presentation. So if at all you are able to answer that question that your asset should be regarded as long term, then consequential provisions allowing indexation will follow. But according to me, first the basic question is still remaining, that how do you consider whether your asset is short term or long term? So the capital asset 45.4, which is getting transferred, if that is long term, then indexation has to be allowed, because alteration is made only to deem the consideration and the cost. There is no disturbance as far as the indexation is concerned.
Okay. Next question is regarding what happens if the retiring partner has already received excess amount in cash before before this amendment, and the retiring partner has also paid advance tax on the same, considering is the personal nature for the assessment year 2021.
So
I think
first of all, there
uh,
was no need to pay the advance tax by the retiring partner as per the existing provision, because the court decisions were clearly helping that retiring partner that it is not a taxable amount. Now, if at all this has happened because these provisions are becoming effective from assessment year 21-22, in that case there is no remedy, but the partnership firm will have to bear the amount of tax liability, and partner will have to claim this advance tax already paid as a refund.
okay. Next question was regarding valuation of revaluation of the asset was done in 2017, and the retirement takes place in 2021. Still, it would be taxable.
So merely because there is a revaluation and retirement, whether it is taxable or not, I don't think that should be an issue. The point which is required to be seen for 4 and 4A is whether retiring partner has been given the capital asset, money or other assets or not. That's the issue. I have understood the question that for the purpose of considering the capital balance for applying 4 or 4A, the revaluation which was done in past in 2017 is required to be ignored. You cannot now see the capital balance including that revaluation credit merely because that revaluation was done in the past prior to the date on which these new provisions are coming into effect.
Okay, so in this case, I think so the capital balance has to be reworked,
Reworked revaluation amount needs to be
ignored.
excluded. Yes.
Next question: if I have received first ever goods for this is regarding TDS. If
Correct.
you have received goods of 51 lakhs
Hmm.
and including 40,000 plus 40,000 as a transport, then
Hmm.
1% TDS has to be deducted on 1.4 lakhs or entire 51 lakhs, 51.4 lakhs.
So first of all, the first amount of 50 lakhs is required to be excluded. The TDS is required to be deducted on an amount only an amount which exceeds 50 lakhs. So in this example, if the transaction value is 51 lakhs, you need to deduct TDS only on 1 lakh. There is one more question about transportation charges, that whether the TDS is required to be deducted on a transportation charges or not. So this particular issue is arising every now and then. For example, under 194J, if the auditor has been reimbursed some amount of the expenses, do you deduct TDS under 194J even on that reimbursement amount? So whatever position which we are taking as far as the other provisions are concerned, the same position will apply. If we take a position that these are the real reimbursement without having any profit element, and a separate documentation has been made, in that case there is a good case to say that the TDS should not be deducted on that.
Uh, whether senior citizen, including NRI exemption, including NRI for exemption in filing of ITRs, whose age is more than 75 years.
Yes, provided that NRI is having only pension income and interest income from that specified bank and files that necessary declaration to the bank. So if you apply this provision, as far as the last question is concerned, if you apply that provision very technically, it says that the senior citizen should not have any other income other than these two. Now here in case of NRI, do you apply this restriction vis-a-vis only Indian income, or you apply this restriction as to global income? So I don't think that it will be logical to apply that restriction global income merely because he has some income outside India which is not taxable in India. You don't allow this particular option to that particular senior citizen.
Okay. This budget is applicable for assessment year 2021 or 22-23. I think so. It is applicable because it is any assessment year starting from 1st April 2020.
So the question is about belated and revised return. The changes are applicable from AY 21-22.
Okay. Next question is when turnover is below 10 crores. I think so. It is 44 AD. Requiring 44 AD, because if it is more than 2 crores, 44 AD is not applicable.
44 AD is not applicable.
45. In case of 45(4), if partner capital is 25 lakh, 25, and firm is giving money of 25 only. So whether this point is applicable at the time of retirement?
So in a case where a monetary settlement is taking place, which is equivalent to the capital balance without taking into cognizance of revaluation, etc., then none of the provisions are applicable. Because in that case, logically also, there is no gain at all. Whatever I had to receive in my capital, I am receiving only that much of amount in a monetary form. And therefore, none of the parties and under none of the provisions, the taxability will arise.
Okay. Sir, questions are completed. I will ask Lalit sir to take over.
Thank you so much.
Thanks, Dipen. Thank you so much, sir, for your detailed presentation and answering all the questions. And at the start, you were questioning that this year you have been taking this seminar where Nearby has been taking since many years. So I think you have truly justified your session, and there is
even
no
if
doubt about it.
even if I have contributed 25% of what Nearby could, I think that I have performed well.
No, sir, you have in real sense,
Thank you.
not just
Thank
for
you
the
so
saying
much.
sake, you've justified your session.
Thank you
And
so
now,
much.
may I request our past convener, CA VJJM, to propose well-deserved vote of thanks to the learned speaker.
Good evening, members. It's a pleasant task to propose a well-deserved vote of thanks to our today's speaker, Bhadresh Joshi ji, who has taken as the impact of union budget in a very excellent manner. All the provisions which are very controversy, he has answered it very well. Sir, we are indeed thankful to you for accepting our invitation. Your presentation is very well drafted. It is like a ready reckoner for us. We can refer it at any point of time also. And also we are thankful to you for spending a valuable time so that we can enrich from your knowledge and your vast experience. Now, on behalf of Borivali Central CP Study Circle, I propose a well-deserved vote of thanks and request the member to carry out with a virtual applause. Thank you, sir.
Thank you. It's my pleasure.
Thank you, sir. Thank you so much for your presence.
So
Thank
we'll
you.
meet tomorrow morning at 11 o'clock. Thank you.